Good morning, ladies and gentlemen, dear colleagues, dear members of the EFFAS Commission on ESG. On behalf of EFFAS, the European Federation of Financial Analyst Societies, and our EFFAS Commission on ESG, I would like to welcome you all to our annual ESG conference held here in Vienna with the kind support of the Austrian OVFA, the Austrian Association for Financial Analysis and Asset Management, of which I am also a chairman. In total, more than 370 people are registered to participate here, with more than 300 people online. You can see that a hybrid format of such a conference obviously allows quite efficient participation from an ESG perspective. My name is Fritz Mossberg. I am head of group research from Esg Group here in Vienna, the leading financial institution in Central and Eastern Europe, and I'm also a deputy chairman of EFFAS. In that capacity, I have been a member of the EFFAS Commission on ESG since its inception. EFFAS, I think, is in the meantime a strong and powerful organization with 17,000 individual members across Europe. Our focus is on the development and implementation of international education programs and regulatory standards. Together with DVFA, the German Society, we launched the EFFAS Commission on ESG in 2007, even before the financial crisis. What has changed since then? ESG is on everyone's lips. First, I believe the existence of global warming is undeniable. Second, we continue to struggle with environmental, social and also governance issues, not only in publicly traded companies, but also in governments. Even rating agencies and auditors, and this is positive, have now recognized that ESG will be important as a comprehensive assessment in the future. Third, in the future, access to equity and debt capital will depend on ESG. Financial institutions will grant loans based on ESG criteria, and only ESG-compliant companies will be successfully listed on stock exchanges. I think this says it all. Why? Because the pressure from the public and financial markets is enormous. In 2007, sustainable assets under management accounted for about 3% of all assets under management worldwide. Our goal at that time was to make ESG mainstream. Since then, we have organized various conferences across Europe, defined EFFAS sector Kpis on the basis of which ESG indices are calculated. Today, the share of sustainably managed assets is around 40% of assets under management worldwide. I think we have, as EFFAS, have been highly successful in accompanying this process and have partly managed to make the topic mainstream. But what comes next? We also need to further implement a future ESG orientation in the sense that a broad range of new business opportunities and sectors will open up. For this purpose, and based on our ESG activities, in 2014, we as EFFAS also developed and launched our very well-received ESG training program, the so-called CESG, the Certified ESG Analyst. The certification has met with great international recognition and already has more than 3,400 graduates worldwide. Since 2019, the international acceptance and number of graduates has also been growing in markets other than Europe, such as in Asia or America. This last point makes us particularly proud at EFFAS, as this year we were able to spend part of the total quarterly training fees for the victims of the war in the Ukraine, which has amounted to 40,000 euros twice so far. In conclusion, I would like to congratulate you on this event and congratulate all for your efforts to face our common future and challenges ahead on. Thank you very much for your attention, and I wish you now a successful conference. And with that, I'm handing over to Frank Klein. Thank you.
Good morning, everybody. Fritz, thanks a lot for the introductory remarks, and also a warm welcome from my side. And on behalf of my co-chair of the EFFAS ESG Commission, Jean-Philippe Desmartins, and myself, we also want to welcome you today, on the one hand here in the room at the Austrian National Bank, and also online, as Fritz Mossberg already outlined. I wanted to give you a quick rundown of what you can expect from today's conference and do some housekeeping remarks. First of all, we are glad that we can do it today here in Vienna, and we have set up 7 different agenda topics, and I'm glad that we got 3 very interesting panels together, and also that 9 members of the EFFAS ESG Commission will participate actively throughout the day. So that's very nice and very good effort from our ESG Commission. What do we have to expect from today's agenda? Quick rundown. We start with a keynote and key discussion about the topic, name of the game in 2022, and I suppose also 23, global sustainability reporting standards, the standard setter ISSB and EFRAG, the way going forward to converge. After that, we will have a panel discussion about the latest trends in ESG. So what do we have expect from the next big things, as we used to say. Then the second panel, human capital at the heart of ESG and intangibles. After the lunch break, we will then continue with a very important and successful EFFAS CESG program Fritz just outlined. CESG 3.0, where do we go from here? After we have been active now with the program for more than a decade and have strived it not just within Europe, but even worldwide, and very popular and successful nowadays in Asia. I think the academic director, Alexander Bassen, will give you a quick introduction after the lunch break. What do we expect in the next years to come as far as this personal training is concerned? Then we are going to continue with a very important topic, which is more or less neglected, unfortunately, but we wanted to bring it more and more into the limelight. What is going on in carbon markets? And I think we have all experienced the up and down with prices and the like in the past few years. So we'll have a very interesting presentation about that topic. Then in the afternoon, how CFOs' jobs have changed with ESG. That's very remarkable from a corporate point of view, because even the corporate board members and investor relation people, they had to react on this very important topic in the last few years and also going forward. So you will learn what is going to happen in the day-to-day job and preparation on board levels with ESG. And last, but definitely not least, I'm very proud that we got some Swedish guys on board for a very controversial topic, which we probably wouldn't have discussed last year, September, when we were in Frankfurt for the last conference, or the year before when we were in Paris. The topic is the conventional weapon topic in a changing global geostrategic and political environment, and I'm already very much looking forward towards this afternoon. Yeah, so this is a rundown in a nutshell. So you see we have a packed agenda with a lot of different things. Perhaps just finally quick remarks as far as housekeeping is concerned. Fritz already outlined, we developed this format as a hybrid format 2 years ago. And so you will have people here in the audience in person in Vienna, as well the majority online. So perhaps from the setup, a few remarks. After each and every part here, I will ask questions to the audience in the first place here in Vienna, and then I open up to the audience online. And behind me, you can see then the chat. And so you can have some questions already throughout each individual part, or when I ask you particular for that. And besides that, for your information, and also for the people who couldn't make it for personal or business reason, the whole conference here will be recorded. And by the end of next week, when we have everything said and done, you will all receive a link so that you can look all the different sessions at your own convenience. Having said that, and without any further ado, I have the great pleasure to hand over to my colleague, Jean-Philippe Desmartins, my co-head on the ESG Commission side. Jean-Philippe, please.
Thank you. Guten Morgen, good morning, bonjour, everyone. I'm Jean-Philippe Desmartins. Thank you, Friedrich and Frank, for the introduction. Thank you for the Austrian National Bank to host us today here at the heart of Europe. We're going to start directly. I'm happy to welcome and introduce Patrick de Cambourg, who is online this morning. Thank you, Patrick de Cambourg, because we know that he has presently a very busy agenda. So thank you for the minutes that we can have with him. Patrick has a long and successful experience and career in the private sector, but also important responsibilities for the public sector, especially in France, where he heads such an example, the French accounting authorities. But today he speaks in the name of EFFRAG, and he is currently a member of the EFFRAG Sustainability Reporting Board. But I do consider, and a lot of people do consider, that he is really the key person today to discuss and comment all ESG and sustainable reporting for EU, but also discussion that will be at the heart of the discussion. I mean, the question of what we do, the development in the EU, but also other initiatives outside of Europe, such as ISSB, but also we see development in the US with SEC, dealing with, for instance, climate change, but also human capital. The name of this first session, the title, the theme is Global Sustainability Reporting Standards, ISB, EFFRAG, the way going forward to converge, with, of course, a question. Patrick, as a start, I let you the floor to develop the first point, which is very important right now, and of 2022. Where are we now for today, for the next month, for also 2023, regarding the different EFFRAG ESG calendars, such as Csrd. Thank you, Patrick.
Good morning to all. I hope you hear me well. Do you hear me well?
Yes.
Okay, wonderful. Thank you very much for inviting me and to this very interesting program. I am honored to have the opportunity to express the views regarding the EU and also the convergence between the EU and other initiatives. So maybe to start with a quick reminder of the CSRD main features. Really what is at stake, if you read carefully, is a serious ambition to meet the challenge of sustainability reporting data quality is at the heart of the CSRD. So it's a step that has been decided by the European institutions to hand up the, the fragmentation of and the poor quality of information related to sustainability matters. The key features, as you may know, are that it establishes a mandatory regime of reporting, which will apply to all large entities. And as we know in the EU, the definition of large entities is broad because the threshold, if I take the number of employees, to become a large entity is 250. So it represents roughly about half of the GDP in the EU. So it's very important. In addition, by the way, SMEs, so entities that are below that threshold, will be encouraged to adopt a voluntary system. Not mentioning, of course, the listed SMEs that will have to comply with the simplified regime. So this is very, the scope of the mandatory regime is key. The second key feature is that, beyond the principles that are established by the directive, we are talking about, a reporting that has to be prepared in accordance with standards to be elaborated by EFRAG, to be transmitted to the Commission as technical advice, and then the Commission will have to follow a process to transform that into delegated acts. Delegated acts means that it is applicable throughout the Union without transposition at member state level. So that's absolutely key. I should mention that in the concepts that are established, there are many conceptual elements that are key in the CSRD, so the legislative level. But I should mention at least one, which is double materiality. It means that you need not only to assess what are the risks for the entity, risks and opportunities for the entity, but also the impacts of the entity on environment and people. And that's where, when we will have the opportunity to discuss, this is one of the possible differences with other initiatives. The third feature which I would like to mention is that clearly there is a key willingness to have quality. So the directive is stating that the information should be relevant, faithful, comparable, understandable, and verifiable. By the way, those qualities match the qualities which are required from financial reporting. So the overall idea is to create a system which would be operational on an equal footing with financial reporting. So I sometimes say that financial reporting and sustainability reporting should ultimately be the two legs on which standardized corporate reporting would be able to walk harmoniously. Another and the fourth feature which I would like to mention is that there is a phased-in implementation that is organized by the level 1, by the CSRD. The reporting will take place first for the NFRD companies, the companies that are already in the scope of sustainability reporting in 2024. And then step by step, the rest of the scope and the SMEs that on a voluntary basis will be expected to either comply with or consider reporting their sustainability reporting. And fifth, and not last, but I will stop there on the key features of the CSRD, the information will be audited. And that's key because, you know, that is creating clearly also the equal footing we are trying to, that is contemplated for sustainability reporting. It means, by the way, that has been organized in 2 steps. First step is limited assurance, and then moving to reasonable assurance. In technical terms, reasonable assurance is what auditors do for financial reporting, but in between, an interim step has been organized, which is limited assurance, which means that, you know, there will not be a full audit of the KPIs, for instance, but the key principles and the processes will have to be reviewed, and an opinion will have to be expressed by the auditor on the quality of the information that is provided by the company. By the way, when we, in the CSRD, I would like to mention with a big smile that sometimes we say reporting entity in standard setting, the directive is talking about undertaking. Okay, so in that, so as you know, the directive has been adopted following the trilogue on June 21st, 2022. And it's not yet in the legal acts because, you know, you have a number of steps to be carried out, like, you know, making sure the translation is okay. Also, you know, there is a legal verification, but that should come very shortly. But the text is now stabilized, absolutely stabilized since June 21st. Since, as I mentioned, I'm going to move to EFFRAG now. Since, as I explained, the CSRD is saying that you need to comply with the principles in the law, in the CSRD, but you also will have to comply. I mean, entities will have to comply with standards, because standards are a key pillar of proper reporting. As we may know, we have the same in financial reporting. We have directive and we have standards. So, and that was the decision that the Commission took early 2020, following the announcement of the Green Deal, that said it's time to solve the challenge of data, and we need to have not only a revised directive, but also a robust set of standards. So the Commission asked EFFRAG to start working on standards as soon as September 2020, so 2 years ago. And in a first phase, which I will not elaborate on for too long, we produced recommendations on the principle that should be followed to have a robust system. That finished in February 2021. And then the Commission, which finalized its proposal, which is now fully adopted, the Commission realized that, you know, drafting standards is an exercise that takes time. So they requested EFFRAG to start elaborating standards as early as, you know, the end of May 2021. So 15 or 16 months ago. So we initiated the task force that had been established in September 2020. It's a multi-stakeholder project task force that has been working very hard, and which has led to, you know, the adoption of exposure drafts at the end of April 2022. So the output of the project task force, which I had the honor to chair, is, you know, 13 standards covering the various topics in the CSRD, which I did not mention, but I'm sure that you are aware. So environmental, social, and governance. So 13 standards in all. One, which is a generic standard called ESRS1, and then 12 covering, the transversal disclosures, ESRS 2, and then 6 topical environmental standards, 4 topical social standards, and 2 topical governance standards. In that respect, so we ended up with a proposal. I can tell you that it was a real challenge because drafting standards in so short a period of time is not always easy. And people worked very hard, and most of them under contributions in kind as members or as contribution for major initiatives around the EU. So, by the way, I express my gratitude to all the people that provided a huge effort. You will hear one of them later today, my friend Alex Basson. So, public consultation was launched at the end of April until August 8. At the same time, EFFRAG had reformed its constitution to organize the second pillar. We had one financial pillar, now we have a sustainability reporting pillar that is about to be finalized because the members are operational since the beginning of March, maybe end of Feb. It was beginning of March or mid-March, and they gave the green light to organize the public consultation on the basis of the exposure drafts prepared by the task force, and the only point that is missing today is the chair, because the chair has to be proposed by the Commission following, a serious process that involves consultation with the European Parliament and also with the Council. This is underway as we speak. So consultation has taken place. And now, as you may imagine, we received about 450 responses. They are extremely voluminous because the consultation itself was voluminous. So we are trying to address and modify the exposure drafts to transform them into standards. We are trying to take on board in the most open manner all the comments that we received. There is statistical evidence because there were statistical questions, but more importantly, there are many comments that have been done by European stakeholders and also worldwide stakeholders. We have 12% of respondents that are not EU headquartered. So this is a process that is underway, and as an example, we had 3 days this week of meeting for the Sustainability Reporting Board to address on a one-by-one basis the most important comments that we received from the consultation. The goal is to reach an agreement at ESRS and EFFRAG level in the course of November, because due to the directive timetable, which is fixed, the Commission needs to have the delegated acts adopted for 2024 no later than June 2023. And in order to perform their own process, which I will mention in a minute, they need EFFRAG to deliver its technical advice, i.e. the elaborated draft standards, by November. Why does it take 7 months at Commission level? Because they are by Csrd required to consult formally 8 public institutions in the EU, including ECB, ESMA, EBA, EIOPA, etc. Formally. 2, they will need to translate the text, which is produced in English, in the 24 languages of the Union. And last but not least, they need to give the scrutiny period to Parliament and Council for a no objection And that's why we are under very severe constraints in terms of timing. I would say to finish on this first quick overview, I would say that the consultation is not a blessing, it's not a rejection either. It's extremely encouraging, but it shows that we have to improve on a number of requirements. In addition, I think there is a crucial point that has to be considered both from a technical and also from a political standpoint, which is, what kind of, even if we agree on the ultimate goal in terms of reporting, there are different views that are possible regarding the pace of implementation. And we have at standard setting level a number of tools like, other sets of standards are contemplated. So you can say this topic would be addressed in a second step or in a third step. We have also the possibility to adopt a standard and a requirement, but say it is applicable with a deferral of 2 years, with early application or not, etc. So this is to be considered. That's what we call the phasing in options. So our work is on the one side to make sure that the reporting is relevant and is offering users the right level of information. But on the other hand, we also have, on the basis of a cost-benefit analysis that has been outsourced to a reputable organization in the EU, we also have to consider a reasonable implementation path, because it's a game-changing step. So we will have to fine-tune the amount which is requested day one and what will be requested over a reasonable period following that day one.
Thank you.
So Jean-Philippe, it's a summary,
yes,
but
thank you, Patrick.
maybe a little too long.
Yes, thank you, Patrick. And we clearly understand that we are in the game-changing period here in Europe. I must precise that EFFAS was part of the consultation. We did a task force with some people coming from our ESG commission, but also people coming from another commission, accounting one, in order to be completely balanced and working with the two legs, finance and sustainability. So we understand all a strong dynamic here in Europe, but also, and this is a positive news, there are also initiatives outside of Europe. And I think you all heard about ISSB, but also SEC in the US is moving. I was saying, especially regarding climate change and human capital. But perhaps, Patrick, you will quote other initiatives. But this is an important point, because here we do represent practitioners coming from corporates and financial markets. And of course, we invest in Europe, but also outside Europe. And really, one question is, are we going to have conversions and optimizations of all sustainability reporting? That's really one of the key questions that a lot of practitioners have. So I'll let you the floor with that question.
Thank you, Jean-Philippe. There are technical aspects and there are also political aspects, and I will refrain from commenting on the quote-unquote more political aspects. What I can say is that from day one, Executive Vice President Dombrovskis said it from the start back in January 2020. We repeatedly said it also. EFRAG and the EU are absolutely keen to build on what is done at global level and also to contribute to that momentum. From a global standpoint, of course, the EU is in a front-running position. And there is always the risk to be isolated because you are too ambitious. But on the other hand, you have the other risk, which is in order to be global, to align on the lowest common denominator. And that's the dilemma I suspect that most of our, political decision makers are being confronted with and are confronted with. And of course, this has a consequence on the technical aspects. So more importantly, from a technical standpoint, we, and I think that you can testify, Jean-Philippe, try to establish cooperation arrangements with all the existing initiatives. So, for instance, we had early on, and we have a relationship with a Global Reporting Initiative, because Global Reporting Initiative is historically the organization that has been focusing on impacts and disclosure related to impacts. And the system is adopted by a significant number of reporting entities throughout the EU, but also worldwide. So we have a great cooperation with those guys. We also established, and I would like to mention this, Jean-Philippe, because I know you are committed with Wiki on intangibles and with Shift on human rights. As regards the ISSB, remember when we started, the ISSB was not created because the decision to create the ISSB was taken at the end of 2021, with the chair being appointed in December 2021. Before that, we had what we call the Technical Readiness Working Group from the IFRS Foundation, with which we had meetings. So we entertain a dialogue with all those organizations, with the SEC also, but as you know, the tradition of the SEC is a bit different. So I can say that from an EFRAG perspective, there is absolute openness to discuss the steps forward. When if I take GRI, GRI was part of our working groups and produced a long document on our exposure drafts to suggest improvements and try to align better. This is considered, as we speak, I don't see a big challenge. As regards intangibles, I think for me, this is a personal view, this is probably something that is underdeveloped as we speak in the exposure draft and maybe in the CSRD as well, but that will come with time. It's more difficult to standardize, quite frankly, but it can be done, but it will take time. As regards the SEC, the SEC has produced at this stage one paper on climate, and as you know, the setup is different because SEC is not a standard setter per se. It's a market supervisor, financial markets supervisor, and therefore they have to work within the confines of their mandate. So their mandate is to operate on financial reporting and risks. So sometimes when you read carefully, you see that the limitations by law of their mandate is creating something that is a bit different, but not that different. At the end of the day, when you have a look at substance, I personally think we are not far apart, quite frankly. As regards the ISSB, we have a constant dialogue. I speak to the chair this afternoon, Emmanuel Faber. So as an example, so there is a constant dialogue, and we have technical meetings and also more strategic meetings, because of course we need to see where the two organizations are going, the EU/EFRAG on the one side and the ISSB on the other side. Yes, the ISSB is having his first board meeting, complete board meeting. I think it was this week or next week. So you know, they had to move quickly and organize themselves by the same token. They have produced two standards. One, S1, which is a general requirements and if I may say so, a framework that is relatively general, but that is also to the point. Under one clear perspective that might be a differentiation with the EU. I say might be because, you know, sometimes it's difficult to see what are the practical consequences. Their objective is to address investors, investor relevance and enterprise value. So in that, you are confronted with a difficult question, which is to say, what are the impacts that are investor relevant and what are the impacts that are not investor relevant or enterprise value relevant? And this is precisely one of the discussions we have from a conceptual standpoint. Is it possible to make a distinction between two categories of impacts, the ones that have, you know, an impact on enterprise value and others that would have no impact, foreseeable impacts? Okay. So,
yes, but
let me just one word on climate, because it's important. On climate, they have a second standard called S2. We are compared, we had the draft when we drafted ours, and they had ours when they drafted their draft. So I personally believe that, yes, there are areas for improvement, but at this stage, in substance, I think we are highly compatible. Of course, with the difference on the the different perspective, double materiality on the one side and enterprise value perspective on the other side. This is my assessment, but I'm happy to elaborate more whenever.
Thank you, Patrick. As a short conclusions, when we see the developments with EFFAG, ISSB, and SEC, we can be, I will say, relatively confident regarding the way all people move towards climate change, which is one urgency. So that's a good piece of information, especially because everyone globally recognizes TCFD frameworks.
Yes, I wanted to mention that.
That's
you
a
know,
common umbrella, if I may say. And
yes,
that's a positive input we can have now. I move to the last point and question before opening for the last minute Q&A session, and I hope that we will have some feedback from the room and online. You emphasize the main difference today regarding ISB and plus SEC, I think we can say that, and EFFAG, which is double materiality. Are there other key aspects when you have in mind today the big differences you see in practice in addition to double materiality?
Frank, well, you know, for climate anyway, I think that the difference is minimal. Why? Because if you have a look at TCFD, and if you have a look as a consequence to the way it's been translated into S2 IFRS or E1, which is EFFAG, you see that in fact impact is extremely is at the starting point of the disclosures. So, you know, from a very practical standpoint on climate, due to the importance of impacts, you know, what we call the inside-out relationship. So what the entity is creating for the environment, I think that there are not that many differences. Now, it might be more difficult for the other ones, but for the time being, my assessment is that due to the TCFD umbrella, I don't see a major difference. That, of course, is in substance There are nevertheless some details that we are discussing. There are detailed discussions, like, do you want to report greenhouse gas emissions net or gross? How do you address offsets? What should be disclosed on transition plans? Because in the EU we have policies regarding transitions, because there are clear objectives that are stated by policies in the EU. While, of course, when you are the ISSB, you operate in a multi-jurisdictional environment, and as a consequence, you cannot mandate entities in China to adopt the objectives of the EU if they have not adopted objectives. So, there are good reasons for some differences, and we are trying to reduce them to the minimum extent possible.
Thank you very much. I'm going now for the last minute, open the floor for Q&A session. I start with the people present here, physically, in person, who've done the effort to be present, so thank you. Is there some question? Because I see already some question online, but if you have one big hot potato, or not hot potato. No? Okay, anyway, I see online two questions. I try to summarize the first one. I mean, for you, of course, Patrick, because of double materiality, don't you consider that we could see a hyperinflation in terms of data reporting and perhaps sometimes an irrelevant one? Because inflation of stakeholders, etc., etc., etc.
First of all, I should say that the key point in the CSRD, but even more in a more detailed manner in the ESRS, I forgot to mention the nickname of our standards are called ESRS, European Sustainability Reporting Standards. So hyperinflation, I don't think so, because both, for instance, the ISSB and ourselves and the CSRD say you don't disclose aspects that are immaterial. So the key element in the approach is, the performance by the entity of an assessment of its material impacts, risks, and opportunities. Of course, there might be requests from stakeholders, but they always have to be considered through the lens of materiality. And for me, I don't know. Relevance is a very difficult concept, because relevant for whom, So I suspect that the question was, is it relevant for investors, and is there a risk that the information be obscured by too many nitty-gritty information that would be relevant for one stakeholder somewhere? I think it's a matter of judgment, and that we will take a balanced approach to that. So I would be relatively reassuring on the risk of hyperinflation of data. At the moment, we are certainly not in that space. So maybe we do not operate under a pendulum from too little to too much.
Thank you, Patrick. I see a second question, which is in line with the discussion of convergent cooperation discussion with ISSB, and with very concrete questions. Could we think that we will avoid double reporting? Because, of course, that's a potential nightmare for corporates and investors, but that's something we have for the financial reporting, so open debate.
Oh, no. For us, the objective is certainly not to have a double reporting. and we need to avoid that at all cost. When I had the opportunity to express my views in front of the European Parliament, I stated that as a cornerstone principle, no double reporting. Now, of course, we need to be close enough because sometimes you have to understand that it's not easy to shoot at a moving target, because we don't know. On climate, I'm confident. I'm confident that we can reach, compatibility. So the minimum we can do is to align on what is absolutely common, which should represent maybe under the circumstances and the TCFD umbrella, I'd say 90% of what has to be reported. Now, if European entities have to add a number of details which are not in contradiction with the ISSB, I don't see why they would have to produce a separate report. It would only be a more detailed report on certain aspects. For the other topics, we don't know, because we don't know yet what are the topics that the ISSB will address next. So double reporting for us is a no-go. So for sure. Now, of course, we are not in the boots of the SEC, so we need to see what is their position. They have asked the question about accepting ISSB as an acceptable reporting for foreign registrants. So let's assume that ESRS and ISSB on climate are aligned and equivalent. I think that would also pave the way to that equivalence, if it is confirmed by the SEC. Now, one last word. We're always talking about human readable reporting, but most people use machine readable reporting. So the digitization is a key element, and I am a great fan of what I call multi-tagging. So when a specific element is in substance equivalent under ISSB, ESRS, and SEC, I would call that, I would put 3 tags on it. So one that would allow an SEC reading, one that would allow an ISSB reading, and the other one that would allow an ESRS reading. And therefore, it wouldn't be confusing. It wouldn't be multi-reporting, it would be multi-tagging.
Thank you, Patrick. So we are completely on time for ending this introduction. Thank you very much, Patrick. And we're going to continue with other exciting discussion and thematic. Thank you, Patrick de Cambourg. Talk to you soon.
So thank you to you for the invitation, and have a great meeting. Bye-bye.
I'm going to let the floor to Frank to continue with the first roundtable right now. Thank you.
Yeah, Patrick, thank you very much. Jean-Philippe, thank you very much. As we already outlined, we are now starting with the first panel of today, the ESG panel. So I would like to ask my 2 guests and panelists here to come on the stage, and another colleague will be online joining from Frankfurt. So I do see Gunnar already.
Perhaps you can introduce him.
Yes, that's fine. So, yeah, first of all, let me just make a quick introduction to my ESG panel. The topic will be the latest trends in ESG. And I think we could discuss with this topic throughout the day, but we will keep it short and see that we get the most important topics done and handled within an hour. First of all, I would like to introduce you my panel. To my right, Fritz Mossberg, you have seen this morning already. He is obviously the head of Erste Group Research. Then he is the deputy chairman of EFFAS. Besides that, he is the president of the ÖVFA and also a member of the ESG Commission. Founder.
Thank you.
So, to my left, I have Dr. René Licolodi. He is the head of equity and deputy of head of asset management and sustainability at Swisscanto. He is also a member of the EFFAS ESG Commission, and beside his day-to-day job, he is a very intensive lecturer at the Swiss Training Center for Investment Professionals, ATSEC, and also at the International Management Institute in Kiev. And having said that, I'll turn to the online audience and to Gunnar Friede. Gunnar is my dear colleague at DWS in Frankfurt, and Gunnar is a senior portfolio manager and head of ESG multi-asset and solutions at DWS in Frankfurt, and he is also a member of the EFFAS ESG Commission. And I'm really proud to have René and Gunnar with us today, because the two of them belong to the founding fathers of the CESG, so to speak. And last night, while we have dinner, we were just reconciling that 10 years ago, so a decade ago, we were all sitting in Berlin, spending a weekend, obviously with Professor Alexander Bassen and some other guys at that time, to really get the CESG program going. So it has a decade long of history. So I'm glad that we have you on board. And from the organizational point of view, I would like to start to give every one of you 5 minutes introductory remarks concerning your individual impressions of the latest trends in ESG. And Fritz, if you would start at the very beginning.
Okay.
With your remarks.
Thanks very much. Yeah, what I'm seeing is that the whole ESG activities and area is not only focused on stock-listed companies, it's also focused on governments and their respective financing on the capital markets. So from my point of view, ESG is also, or has to be included in future, also, for example, from rating agencies. Rating agencies, by the way, play an important role, but most of them are still very much focused on financials, which is of course of importance. But now, for example, if you're looking to macro indicators or other debt levels, by the way, all the debt levels are higher for more or less all the states worldwide since the financial crisis. Then came the pandemic and now the war, so debt levels are furthermore increasing. Perhaps with the inflation now, the states can reduce somehow the debt levels, but overall I think also rating agencies have to be much more focused on ESG issues. Why? Because I think also a transparent communication is key in that respect, if you are especially focusing on the E, on the S, and also especially on the G. And countries who would have problems in this regard and show misconduct, I think will have definitely problems in raising funds, and therefore they will for sure have to pay risk premiums in future if they are not fulfilling also ESG criteria. On the other hand, and that's my last point, which I perhaps see as a latest development in the ESG area, with increasing gas and electricity prices, I think we saw recently huge pressure on utilities and electricity companies, for example, in Austria. And this is not only on stock-listed companies, it's also on not listed companies, because, of course, it's very much driven by households. It's very much driven by the public opinion and media, and therefore more and more also ESG criteria are also playing a role here. For example, in Austria, the people would like to know exactly what a electricity company is doing in terms of electricity price trading, because there are obviously some firms outside which have a huge portion in electricity trading and not so much in electricity production. Therefore, I think from not only from shareholders, from the public, from stakeholders, the pressure on utilities is really further increasing.
Okay, Fritz, thank you very much for these interesting points, and I think we'll elaborate on this after the first round. Gunnar, I would like to ask you to continue with your impressions, what's going on in ESG right now, and what are the next trends we are going to face with?
We cannot hear you.
So I'm unmuted?
Now it's fine.
Okay.
That's fine.
All right, perfect. So hello, Vienna. Thank you for having me on the panel. So what are the trends? And I think Fritz really put it nicely in his introductory statements to the conference. I mean, we have seen so many developments in light speeds in the last 5 years, and we have now more than 3,000 certified ESG analysts. And so it would be really tempting to say, with MiFID 2, with SFDR 2 coming up for next year, Csrd upcoming, to ask about more and fancy data. But actually, I'm not doing this time because I think I'm concerned. And I'm concerned because we are a little bit losing track, I would say. So let me get one step back. We have now, according to Morningstar figures, roughly 50%, or actually more than 50% of the European fund universe that is in Article 8 and Article 9 funds. So that's a huge development over the last 3 years. And it's also projected to grow further, and I also hope that it will further grow. But what have we achieved with regard to the EU action plan? And this is where I have, some of my concerns here, because actually the idea was to reorient private capital into sustainable investments. That was the original idea. That's why it was designed like it is. And if I look on the statistics, what actually is going into renewable energy investments, then I see, yes, there was a nice uptick in 2020 and 2021, but 2022, in a situation where Europe is most urgently of need for renewable energies, as we know, we have a situation which is projected that 2022 renewable investments and also maybe the next years will go down. And they are actually below 2010 or 2011 or 2012. And they are, let's say, more or less on the level like 2015 or 2016, where we talked about SDGs and the EU action plan for the first time. So I think this is really worrying me that we are, besides having on the paper and also with regulatory requirements, done so much. But actually from what is the real impact, we may take a step back and really think again of whether we have achieved these plans and how can we do better. And I think, so what would be for me the trends and necessities? I think renewable energy investments are as profitable as ever, because you can see levelized cost of electricity, it has gone down massively, and it should be easy to really invest in this. But we need to speed up the renewable investments, and I think to really focus on this, that we don't have 30 years of time, as we know, and that's why I think instead of talking about windfall profits for renewables, we should talk about reploughing all these additional, let's say, cash flow into renewable investments. Otherwise, we won't unsolve the situation right now. And I think the next part would be to really think about the foundational data that we are using in order to construct our Article 8 or Article 9 funds, being the principal adverse impact indicators, the social investments, and of course the EU taxonomy relevant assets. And I think we are still far away from having a golden source on this. And don't get me wrong, I think it's totally fair to assume that every rating agency and every investor can use their own data and their proprietary methods to determine what is ESG, but we need to have a clear and common understanding of what are the foundational data points that we need in order to construct the portfolios and also to exclude companies and include companies. And I think 3 years ago, we had the real hope that the EU is stepping in, providing these, let's say, really foundational data. And I think nothing has been achieved in that respect, which is really a pity. And I think this is really one of the weak spots, I would say, and this needs to be fixed and really urgently fixed. And then it needs also to be coordinated with also the new CSRD framework, where we still have the, let's say, deviation between what is asked from investors and what corporates need, and in which way corporates need to report. And this is, for me, totally surprising that this is not, let's say, harmonized in a way that we are talking about the same indicators and that we are talking about also the same timing, because the financial industry is reporting on data which is basically very much estimated. And this, I would say, need to be considered and fixed for the future as well. Thank you.
Great. Thank you very much, Gunnar. I think, especially with the quality of data, we will come back to this topic, I think, in the discussion afterwards. René, let us turn to you, what you consider to be of utmost importance in ESG going forward.
So thank you very much also for having me here. Let me try to make a maybe slightly provocative counterpoint here. So I have the opportunity, had the luck to look at the development of ESG since 2001, as I started my career as a sustainability analyst when there was no data around, basically. So looking at this time frame of roughly 20 years, well, not so many changes have actually happened, to be honest. ESG investing is rather simple. Let me explain you. If you know five instruments of ESG investing, you get the picture. We're talking about exclusions. We're talking about, secondly, about best-in-class approaches. We're talking about voting and engagement. We're talking about thematic investments, and we're talking about impact investing. These are the 5 instruments. If you know these 5, you basically have a good grip on what ESG investing means. Well, these 5 instruments were all around 20 years ago. 20 years ago, I was having discussions about exclusions as I have now. Now it's about weapons, maybe it's about energy, it's still about divesting or not. Does it have an impact or not? It's the same discussion. Best in class is still around, pretty much unchanged, with better data, yes. It's more sophisticated, but basically the methodological approach is still the same. Thematic investments, we're still talking, and that makes sense, about the same structural trends, which are very, very long-term. It's about mobility, it's about urbanization, about demographic changes, it's about climate change and energy transition. Well, 20 years ago, same topics. Remember, on Convenient Truth, 2005, 2006, Al Gore, climate change in the footprint, still the same topic. Now, maybe we have biodiversity, which comes a little bit new, as a new boy in town, but very relevant. But other than that, we're still talking about the same thematic megatrends that we had 20 years ago. Voting and engagement, that has slightly changed for continental Europe because it was most, I would say, a thing coming from the US and the UK. That has definitely reached Europe. Why? For 2 reasons. One, because we have massive indexing growth in Europe, so a lot of passive investors. The only way passive investors can have an ESG role or an ESG discussion is by executing their stewardship by voting and engagement. No other means, because the fist will always stay behind the back. They cannot reallocate the capital. They're following a benchmark. So indexing has been a catalyst for, I would say, stewardship, voting, and engagement. And at the same time, also as a catalyst for this topic, the changing fiduciary duty or fiduciary responsibility has changed over the past 10, 20 years. So 20 years ago, it was clear your focus is risk return, and that's it, and that's only it. Now, you are much more aware as a large asset manager, as investor, that basically beyond your fiduciary duty, you might have a responsibility as a big owner of companies. That also brings in the whole ESG topic. Lastly, impact. That was also around 20 years ago, recall of all the, let's say, microfinance funds, private equity funds, which were focused on certain sustainability topics. That has definitely changed. And it's also the area of I think, the biggest misunderstanding that we have. ESG per se was not, and I disagree maybe a little bit with the Mr. from EFRAG, was not, I think, not invented to have an impact. It was invented to have a better set of information, to make a better risk assessment, to make a better opportunity assessment of your investments. It was not per se invented to have an impact. So here, if we talk about impact, usually it's about alternative asset classes. It's about new capital allocated to companies, private equity. It's about new capital allocated in bond issues, green bonds, social bonds. It's about new capital allocated to, let's say, infrastructure projects, and so on. This is generating the most impact. So, looking at this time frame of 20 years, I'm a little bit, let's say, disappointed that we haven't changed more, to be honest. And at the same time, well, yes, there has been changes, and I point out 4 of them. Trend 1, the legalization of ESG, okay? So just think about how many legislators today are talking about ESG and are making the law all around ESG. Often, at the same time, learning about ESG, but making laws about ESG, okay? Secondly, the amount of internal compliance people that I have to deal with all around ESG issues is just exploding. So I have more discussions with compliance officers and legal officers about ESG topics than with my investment guys, which is impressive. And thirdly, the supervisory bodies, like the CSSF, the FINMA, Switzerland, and the BaFin, they are basically assessing and approving the ESG compliant products. So you have at different levels a legalization of ESG topics, which has come up over the past, I would say, 2, 3, 5 years, which has been astounding just to look at. That's the first trend. The second trend, which is a little bit linked to it, is the wish and need of the standardization of ESG. So there is a strong need, and I think it's a legitimate need to have a more standardized understanding of what ESG means and what it doesn't mean. Just think about the rating agencies, which have been named before. So there's an interesting scientific paper by the University of Zurich called Aggregate Confusion. The one of you maybe know that paper. Aggregate Confusion analyzes different rating agencies and finds a correlation about different ESG rating agencies around 0.4. Okay, the correlation of credit agency ratings is roughly 0.9. For me, that's not surprising at all. Like, not at all. If you look a little bit deeper, these rating agencies are working with different sets of data points, with different sets of quality of these data points, apply different methodological approaches to generate the rating, different weightings. And obviously, the results differ. So you can have, for the same company, a wide set of different ESG ratings, which is confusing for investors, is confusing for companies, and it's even more confusing for the legal bodies trying to make laws, assessing portfolios, making taxonomies, and so on. So obviously out of that, the need for standardization is really big, and therefore the work of an ISSB and other bodies is really important to at least establish the lowest common denominator on certain relevant things. Think of CO2 emissions, which is basically a quite basic data point. It's about CO2 emission scope 1, 2, and 3. In the reality, it's not so basic. I make one fast example. Scope 3 emissions have been a discussion point again for the past 20 years. I was looking at CO2 emissions 2006, 7, 8, talking about methodological approaches to discover scope 3 emissions, which are the most important part because they make roughly 80% of the emissions of the total is scope 3. It's not scope 1 and 2. Now, usually you don't have good scope 3 emissions on the market. Now there are big, large data providers which come up in the past few months with scope 3 emission data. Everybody's happy. Well, we have scope 3 emissions. If you look at the methodological approaches, they're not corrected by double countings. This is methodological, I'm not saying crap, but it is. Because basically you count the same emissions a multitude of times without correcting it. If you base your Paris-aligned benchmarks, your strategies on scope 3 emissions without correcting for double accountings, you run into serious problems. You're not able to make a credible, consistent net zero strategy, for instance. So these are problems that need to be addressed from a standardization point of view, from a regulatory point of view, in order to help investors and companies to come up with, let's say, consistent, valuable strategies. Third trend, also linked to this, digitalization of ESG data. Think a large asset manager that wants to integrate ESG data across a large number of products. Swisscanto, Kpis asset manager, we manage 220 billion in assets under management, roughly 200 plus fund strategies, and we have the aim to integrate ESG data across all the strategies. That implies you cannot do this if you don't have a sophisticated IT platform which is able to manage large data, which applies machine learning and AI algorithms to analyze the data on the analysis part, which is then able to make good investment decisions in the production part. And obviously, the most important last step is to be able to produce on an automated basis reports for the clients, which need to be in line with what you analyze and need to be in line with what you make in your portfolio. Okay, if you say I have a reduction path, you need to have the data, the analysis, you need to be able to construct portfolios and need to be able to show what you do in your portfolios in a reporting. This is basically digitalization. Not anymore possible to do this in a manual way with the amount of data you need to analyze and let's say, produce in such a value chain. Last point, education. EFFAS has been, I think, in the forefront of the ESG education, as Frank has mentioned, over 10 years ago, trying to push out a standardized and valuable program. Now you have ESG courses all over, which is a good point with all these legal guys and investment guys and analysts and portfolio managers need to be educated on the value of ESG data in a realistic way, not being overexcited. ESG data per se is not an alpha generator. You will not generate a better performance just by taking ESG data in. It needs to be integrated in investment processes. It needs to be analyzed in a certain way in order to enable better performance. And that's the role, I think, of education, and that's the fourth large trend that I see.
Great. Thanks a lot for these very interesting points. I think we will also come back to some of them in the discussion. First of all, I would turn it now, after you have heard these three inputs from experts on ESG for future developments. I would like to open the floor, first of all, here in Vienna. Are there questions, answers, remarks on the things you have heard from the audience here? Just wait, because you'll get a microphone, because otherwise the people online couldn't hear that. Microphone is coming. Please.
Thank you. One question on the last comment you made. Would it make sense to integrate ESG in the performance attribution system which is used? Not only include like currency, timing, location, and also ESG, or should it not be included?
No, absolutely. It would make sense. It makes sense. And you have one or two problems with it. One is if you make a performance attribution based on, let's say, the so-called market betas, the risk factors, you need to be sure that it is a risk factor. Okay, so you have the classical, let's say, Carhart factors, which you have the market, you have the momentum, the value growth, the size. These are the classical ones based on decade-long statistical data in order to, let's say, identify that it is a market risk that allows you then to make a performance attribution and distinguish between idiosyncratic risk and market and factor risk, okay? Now, you don't have the breadth, I think, the necessary breadth and the necessary length of data in order to establish in as much the one or the other ESG factor or aggregated ESG factor has the quality to become a, let's say, systematic factor, which is the lead in order to be able to make a good performance attribution. We did studies back 2008-09 to enhance the Carhart model with an ESG factor. We did that with a university. The results were positive, but still with a certain, let's say, insecurity because of the length, the missing length and quality of data. But that will change over time.
Okay, thank you.
Thank you very much. Any further questions, please?
Where do you see the role of equity investment in order to accelerate ESG topics?
Whoever wants to answer, Gunnar, Fritz, René.
Perhaps Gunnar.
Gunnar, perhaps as also an investor's point of view.
Yeah, I mean, the current situation is that we probably have to focus on the bond side because the, let's say, transmission mechanism via green bonds is working from a listed perspective, let's say, faster and more direct, I would say. On the other side, as we know, it's about total, of course, capital allocation, and not only for fixed income capital, but also for equity. And therefore, I think in the long run, the equity markets are really, really important. It doesn't need to be underestimated. What I currently see as a worry, and this really worries me, is that the ESMA and also the CSSF probably not thinks in that direction, that they have a tendency, at least from my gut feeling, to really more focus on the green bond side and on the debt side, because on the equity side, it's not so easy to, let's say, talk about the direct link of, for instance, sustainable investment shares and so on and so forth. But I think you are totally right. The equity side is, from a total risk perspective, from an equity perspective, really, really important, and we shouldn't underestimate that. For me, it's really both sides, the fixed income side, the equity side, and of course the direct link via the alternatives channels are really the key ones.
Perhaps I just add one sentence on that, because if you are looking just to the stock-listed industry worldwide, to all that large caps, we made a calculation years ago that they represent more or less also via various channels the largest portion of the GDP production worldwide. So that means they represent roughly 80% of the total GDP, which is more or less generated by the stock-listed industry. And therefore, it is important that ESG is a topic on the equity side.
Now, from my perspective, now I'm hardcore equity guy, so I'm totally biased here. At the same time, well, it's clear. If you own equity, you are owner. Okay, you are owner. So we are a Swiss asset managers. We manage roughly on the active and index side, we manage 16 billion in assets in Swiss companies. So for every Swiss company, we are in the top 5 to top 10 owners of this company. That means we have direct access to CEOs and boards. That means we are heard. That means we can influence. And we've done that with, let's make an example. We have a strategy which we implement for all our active approaches on the equity, fixed income, and balanced side, which it's a quantitative climate reduction path, which in every year we reduce the carbon intensity of your portfolios. Quantitatively, mandatory for every portfolio, PM needs to execute it, unless he won't get a bonus, okay? As simple as that. But that means you have two instruments to act on the portfolio side. One, you reallocate your capital, okay? Sometimes you don't want to do that because you think, well, the companies are actually good. So the second element is engagement, okay? So we talk very actively to large companies, let's say in the cement area, to have SBTI aligned carbon strategies. We follow up on that. We control the data. We want to see if the path that the company makes is aligned with the things we want to see in our portfolio. And that doesn't generate necessarily a short-term, right now impact, but over time, together with other investors, you move the market in a certain direction. If I go back to my initial times, 2002, when there was no reporting, GRI was just starting, and no ESG data, we wrote to companies, we send out questionnaires to companies all around the world asking for ESG data all the time, permanently, together with other, let's say, early stage investors. That definitely triggered the growth of the GRI, the awareness on the corporate side that potentially this set of investors is important and we need to scale up our efforts on the ESG data providing side. So yes, as an equity investor, you can have an impact. At the same time, if you want to have a direct impact on sustainability, well, you need to go into alternatives. You need to provide new capital to young firms. And if you look at the trends, more companies today are moving into private, from public to private, and not from private to public. That's a very interesting trend over the past 10, 15 years, if I look at US statistics.
Great. Please, just wait for the microphone.
Thank you very much for your remarks on trends. It's really interesting to hear that not only ESG is applying to businesses or to investment targets, but as well as to governments and rating agencies are paying more and more attention to this. Thank you, Fritz, for this. Also, René, I'm not absolutely agree with you when you told that you have a contradiction with the first speaker when talking about impact or quality of data. From my point of view, it's another vision on what is ESG standards should be, because it's really important now to standardize this information, not to have a biased data. Thank you very much, the panel.
Thank
you. You know, I agree with you on the need of standardization. At the same time, you will not standardize the way investors are using the data. Just make an example. If I look at any listed company and I look at the analyst recommendations of any listed company, and we are talking about accounted financial numbers reported every 3 months in the same way for the past many, many decades. Well, the results of the analyst recommendations are usually 10-20% buy the stock, 30% hold the stock, and a few, let's say, divergent analysts say sell the stock. So even if the numbers are the same, so why should we aim for ratings that suggest that there's only one view on a company with regard to their ESG profile? we should aim for a standardized set of information.
Yep.
What I make with the information should remain a value proposition and should generate friction among market participants, because that's the role. Generate information exchange, reduce information asymmetries, give pricing signals. That's the role of capital markets, and that should also be the role for ESG data.
Yeah, that's a very important topic from my point of view. Why? Because, of course, we should reach somehow a level of standards which are harmonized. But I think if there is only one standard outside at the end, it's a monopoly. It's also not good. And therefore, what René said before is important because, of course, different asset managers are running qualitative models, are running quantitative models, but that's the market. That's the variety of different opinions and different evaluations, and that exactly makes a market. Just having one standard at the end is for sure also not a common goal which is good for any functioning capital market, I would say.
I as an investor, I want to have standardized, third-party accounted, proven data points from companies or from whoever. That's what I want to have. What I do with the data, in my office, I will never use third-party ratings, ever. I want to aggregate the data that I think is good in a way that I think is feasible and helps my investment decision-making process. That's my job.
Perhaps as a summary of what we have heard, the three of you outlined how can we improve the quality of data. René said you were coming over 2 decades from A to B, but it's not good enough. Gunnar also outlined that. So my question is, when we talk about the rating agencies and their importance for market participants, one way or the other, and the data, and this afternoon we will hear from the Austrian Post the idea from the horse's mouth, because the corporates have to deliver the data one way or the other, disregarding whether they go directly to the investors or analysts or via the data providers like the rating agencies. What would be your concrete recommendation? How can we improve from here? Yeah, you said we spend too much time with regulation. Unfortunately, I think there will be no good news from that side. The next 3 years, we will spend also a lot of time with regulation. But what can we do concrete in order to give you better data? And René, you outlined the scope 3 things where you don't even have the double counting problems. So what are we going to do in order to improve?
When it comes to rating, that's a special topic from my point of view, because rating agencies play an important role, but on the other hand, I think they learned also a lot during the financial crisis, as you know, because a lot of rating agencies also rated subprime instruments with AAA. Anyway, therefore, I think it is important also from my point of view, because as you know, all these large rating agencies have these rating scales, and it's more or less more than 20 different ratings where a rating agency can focus on. But on the other hand, they can hide quite well with the different ratings. When you are looking just to what we are doing, or what investment banks are doing, it's more or less simple. It's buy, hold, sell, or it is buy, accumulate, hold, reduce and sell. So it's a pretty simple rating scale. And if you're looking to the rating scales from rating agencies and also the evaluation, the traditional evaluation, not taking ESG into account, is more or less also a black box, because you cannot get the information how they are coming to the specific opinion. and everybody is doing it different. And therefore, I think perhaps a little bit more transparency in that regard would be also great.
What do I need or what can we do? Radical simplification. So take out as much as possible the complexity out of processes and data and ratings and everything. So therefore, I expect from the regulatory bodies, the work of the ISSB, to go simple, achieve maybe less complexity, but where they act, let's say, example, CO2 data, be very precise and establish at least a lowest common denominator on certain things and do these things well, then try to achieve everything, but create a huge complexity that nobody understands and nobody is able to handle right now.
That's the point.
That's my wish, point one. Point two, rating agencies. Let me make you an example on the credit rating agencies. So if you are a manager and you manage a corporate bond portfolio for institutionals, and there is a large client who is seeking a new asset manager for a corporate bond portfolio, you need to be able to show to the consultant or the client that you have your own rating research or credit research capabilities in-house. You cannot go there and say, well, I rely on Fitch, Moody's, and S&P, and that's enough. Well, that's just an information you have, but you need to do your homework. That's the traditional fixed income world. So this is not different on the ESG side. Well, yes, you can look at what the rating agencies are doing, but you need to do your own homework in understanding what kind of data leads to what kind of investment decision. That's the basic work you need to do, and in order to be able to do that, you need to have talent, skills, knowledge, and experience. So you need to invest if you haven't done that in the past. That's quite, I think, a simple logic for success, because you won't be able to explain to any client a third-party ESG rating with 750 sub-indicators, which is just not you don't understand it, and it changes all the time.
Gunnar, anything from your point to add on that?
Yeah. Actually, I think we are not so far away from what René also said and Fritz. I think on average, the ESG ratings are, let's say, higher correlated than we may think on average, in particular for the leaders and for the laggards. So I think if we're stripping out one of the typical ESG rating providers, on average, the rest of the ESG rating providers is way higher correlated, around 0.7. Just to, let's say, bear this in mind and compare this to the 0.9 on the fixed income world, I think considering the multidimensionality of ESG and considering the thousands of sub-indicators going into this is tremendous with regard to what is, let's say, the common denominator on the highest level. But I'm not so much on this side. I'm really more, let's say, concerned on the foundation of this. And I totally agree here with what have been said before, and what I made also in the intro statements. We need to focus on these real important foundational data points. Carbon is one thing, and I couldn't agree more. Scope 3 emissions are 80% estimated, and alone the MSCI all-country world generates the double of the Scope 3 emission that is, let's say, emitted globally, just to bear this in mind. There's so much double counting of, let's say, in the autos, in the chemical side, on the airlines, and so on and so forth. So huge issue. But of course, we need to rely on this, and we are asked by the regulator to rely on this. And this is something where I really see a huge mismatch, where we need to focus on carbon aspects and all the other related PI aspects like gender pay gap, biodiversity, and also with regard to the other environmental indicators, where we really need to have a foundational basis that we can rely on, and where everyone can make their projections based on this. And this is where I see the ESG rating agencies should be helpful and need to be helpful to combine this, condense this, make some estimates where we have some gaps, but in the end make the projections. And we, of course, as every investor, we need to make our own mind. What is our own definition? What are the data points that we need to focus at and compare this against? But I think if we have the foundational set of data, then we have achieved a lot. But unfortunately, the CDP has been founded 20 years ago, and we still only have reported numbers for scope 1 and 2 emissions that are less than 50% of all the corporates. So the rest is estimated in particular for the rest, and this is just one example of where we are. That's why I think it needs to be stressed. Let's focus on the groundwork, on the layer, where we can build the rest of our ESG world on it.
Great, thank you. We have some questions from the audience here in Vienna. Please.
Thank you. One question. I mean, I fully share your views with regard to active management, but one question would be, now we learned that roughly 50% of asset under management are ESG managed within Article 8, Article 9. Now, how much of that would actually be active managed and how much is passive managed? And I think this is a bit of my concern. Of course, it's your decision as an active portfolio manager to give trust to the rating agencies and actively do your own decisions. But when you have a passive product, I think you're tracking some ratings or whatever. And my fear is that this passive share is relatively high and is gaining importance, and that's why it's moving the market.
Well, as an active manager, but who has also in-house a very large indexing business, I can tell you that the ESG index business will grow and will grow fast. Okay. Now, as somebody also very convinced about sustainability, ESG data and active management, I think for the moment and for the years to come, a large part of good ESG investing will remain qualitative. And by being qualitative, it requires fundamental analysis. Okay? Make a differentiation between how a company acts and what it produces. The ESG data part, for the most part, focuses on the how. So how a company produces the services and products. Energy efficiency, water, and blah, 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 which is important. But usually, you don't have good information on the product side, the what, the products. Okay? That's usually focused by qualitative analysis. You need to understand the product, you need to understand the technology, you need to understand the market, the competitors, the peers, and everything. There's no good ESG data. So that's also my concern when we think about SDG investing with the 17 nice goals, because here we usually focus on the what kind of products and solutions lead to an impact on the SDG side. This is hugely qualitative. I close the circle. If it's qualitative, if it's fundamental, it's not indexed. As simple as that.
Yeah, if I may add, I mean, I think there is nothing wrong about the active versus passive discussion. Of course, we would rely on just one single provider in that regard. You are right. But on the other hand, I think if we have a more common denominator, then I think it's also acceptable to have such strategies. And of course, you're right. The passive side is around 50% in all the assets. In Europe, slightly less. In US, slightly more. But of course, it's a huge, let's say, part in that regard. But the main question is, when it helps to really channel the investments into renewable investments, into the right social and environmental projects, I don't have any problems with that. And this needs to be assured. And this is also been taken up by the regulator with regard to auditing, for instance, the ESG rating agencies and, of course, the index providers. So I think on this side, I don't see any huge issue. We can discuss about, let's say, engagement and other related topics from the passive side, which may also might be interesting. But from the channeling of investments, I think every euro helps to solve our long-term problems.
Thank you, Gunnar. We do have one question from online before I turn to you. Why is the industry investors not coming together to build a sensible data set? What would it take to come together as industry participants and not waiting for regulators? So how to organize ourselves, so to speak, instead of waiting for regulator input? Is it possible at all?
I would be a little bit skeptical. I would be a little bit skeptical on this. I think that is not typically our, let's say, business and our expertise. And I think we need to rely on intermediaries and also the companies reporting the data. So I see our role as investors more in the area that we are actively asking the companies to provide that data and also then channel it back. And this is, I think, is what we are doing also with regard to our engagement strategy, that we are asking companies about reporting on EU taxonomy, reporting on sustainable investments, reporting on certain biodiversity issues, respecting the SBTI and so on and so forth. This is where I see our main role in that.
I mean, the industry is coming together to a certain point because the industry is represented by the likes of EFFAS, EFRAG, is taking part in the discussions with the ISSB. So investors are actually focusing on that, but to have the belief and the vision that the investors themselves come together, well, there the competition is simply too high. If I am able to extract a sensible data set for myself, that's gold. And data is the new gold. I won't share that with anybody else. I will keep it for myself and try to make the best of it.
On the other hand, perhaps just add one sentence. I think when an industry is setting standards, perhaps it's good if the asset management, and I'm not a representative of the asset management industry, but if the asset management industry is, for example, doing its own code of conduct, it's okay. But if they are setting their own ESG standards, I think it's also not good from a perhaps compliance point of view.
And perhaps just as a summary to what Jean-Philippe said this morning at the very introduction with Patrick, we as EFFAS participated very actively in the current consultation. So we raised our hand and we said, look, the EFRAG consultation was too tedious because it was too granular, and ISSB was not granular enough. So we just encouraged these sort of role setters by taking their heads together in order to come to a common conclusion. That's what we said. And I think this is our goal also as a European association. Detect what's going wrong and go for the standard setter and push them in the right direction in order to get what is necessary from an investors, from an analyst, and also from the corporate point of view. But you had one question, please.
Thank you so much. Actually, I have two questions, if I may. The first one is talking about standard. We know the new ESG fund reporting standard, it's called European ESG templates. It's coming out, and we're reading the news that a large part of the Article 9 funds will threaten to be downgraded. I want to know your opinion or your thoughts on it. And the second question is talking about rating agencies. Do you see new rating agencies emerging or coming, gaining importance with ESG focus? Thank you.
I just can answer the second question. Of course, the whole rating agency market is mainly dominated by the three large rating agencies. You name it. There is a larger rating agency in Europe now coming up, but I never heard something really in concrete terms what they are exactly doing. There is, from my point of view, a Chinese rating agency, and there is also another rating agency, but I think they are based in Canada mainly. It's the fourth largest rating agency called DBRS. So it's more or less focused on US, North America with 4 rating agencies that they are dominating. It's a Chinese rating agency and a European one. And there are some specific ESG rating agencies, as you know, but they are more or less also operating in a different market somehow.
Yeah, so I agree on the rating agency side. For your first question, it's very simple. It's a mess. It's a complete, utter mess. So we are in the middle of looking at Article 9 in the new world. Basically, the law is not clear, is not well formulated, is open for dozens of misunderstandings. The consultants that you take on board, and you try to ask them, well, how should I interpret that and that point, are not able to give you a good guidance on that. And finally, when you talk to the supervisory bodies, which should accept or prove your templates, they simply don't know how to handle it, because they don't understand the law very well. They have the same questions about the laws. They don't know the ESG part of it, and they would need to take these parts together in order to give a clear signal. And that's a recipe for potential huge market risks and a bad outcome for the ESG topic, and that would be a fallback in greater terms. And I'm not sure how we could avoid that, to be honest, at the moment.
Gunnar, anything to add from your side?
Yeah, I'm also concerned looking on the data from the EET, where you see that 80% of the funds of the Article 9 funds don't report any sustainable investment shares. That's certainly, let's say, an issue. I think it's also, on the other hand, an issue that Article 9 was relatively broadly defined in the first stage, and then later on in the course of this year, the regulator then have a let's say, new definition of what he thinks are, let's say, achievable or necessary sustainable investment minimum shares. And I think there needs to be find a balance because otherwise, as talked beforehand, the regulator will only channel money in the end into green bonds and will leave out the rest of the investments on the equity side and maybe also on the multi-asset side, because I think the levels that we are hearing of what is, let's say, the regulator's target are maybe relatively high. So we'll see how this turns out. But I think it's good that we have the EET where we see the minimum disclosure that every fund is targeting, and then also see, on the other hand, what is the actual sustainable investment share. That's certainly a good thing, but the rest will be written in the next couple of months. It will be quite interesting, that's for sure. On the other hand, once again, it's important that we channel the money into the right equity and fixed income proportion, and we shouldn't really forget about the multitude of really assets that need to go into the right direction and not kill, let's say, some asset classes because of some regulatory demands that cannot be fulfilled in certain asset classes. I stop here.
Great. Well, thanks a lot. I would consider this to be a very good closing remark. There's a saying, time is flying when you're enjoying yourself. And I think this hour passed by very quickly. So first of all, I want to thank the active audience here, also the audience online. And in particular, I would like to thank my panel for a very transparent and very intense discussion. So please give them a hand. So thank you very much, guys, for your participation. And without any further ado, I would like to hand over to Jean-Philippe again, because I don't want to steal either their time or their thunder for the next panel.
Yes, hello again. Thank you, Walter. Please join us. So we have now the last session before the sustainable lunch break, of course, which is an important point and part of the event, especially to network for those who are present. So I have the pleasure to moderate the next panel dealing with human capital at the heart of ESG and intangibles. And I'm just going to welcome Daniela Carrozio, who is online, Walter Hatak, who is present here physically, and Professor Stefano Zambon, who is also online, and I will introduce them. A few words. You notice that between 2015 and 2019, there were a lot of, among Sustainable Finance Committee, a lot of debates and challenges and projects regarding environment, and that's still the case because climate change, biodiversity, and so on. But you also notice that starting in 2020, because of COVID period, but also because of the war in Ukraine, there are more and more debates and urgencies, projects regarding social issues. And that's a good news because I refer to the definition of sustainable development, Breton Report 1987. We celebrate the 35 years of this report. Thank you to Mrs. Brotland from Norway for all the achievement. And in one sentence, the objective is to balance our development with mastering at the same time environmental and social issues. So we are very happy to address also social issues and human capital. For that, we have three great people with complementary experience. We have Professor Stefano Zambon, who is a professor at the University of Ferrara in Italy, and a member of our EFFAS ESG Commission, and it does a lot of things regarding ESG, especially regarding intangibles, and Patrick de Cambourg referred earlier this morning the collaboration regarding intangible with World Intellectual Capital Initiative. And he will introduce this session with the academic input. Then I'm happy to present you Walter Hatak, Head of Responsible Investment at Erste Asset Management here in Austria. And he will present in the introduction the investor input, investor point of view. And last but not least, we will have Daniela Carrozio, who is Senior Partner, Sustainable Value Investors, also member of our ESG commissions. And she works with different stakeholders, including, of course, corporates. And so she will present in the introduction the corporate point of view when we think about human capital. And then we will have some questions and, of course, the Q&A session with you, people in person and with the online and people online. I start with Professor Stefano Zambon. Stefano, I let you the floor. I think that you sent some slides in addition to your speech, and I remind you that we all have 5 to 10 minutes each for this introduction. Thank you, Stefano.
Thank you, Jean-Philippe. Thank you to the EFFAS CESG. I'm sorry if I cannot be with you. I prepared a few slides just to signal to you a few conceptual issues that I have in my head when we talk about human capital, which is, of course, as Jean-Philippe just mentioned, a very important topic. Is becoming, is clearly on the rise also in the United States. Let me share with you a few slides here. Hope you can see them. Please let me know if it's fine, the vision is fine. Yes. So a conceptual perspective, because of course, not only because I'm academic, but I think also in order to understand and to measure what we want to measure, we also need to understand exactly what we would like to measure. And so a preliminary conceptual dilemma I would like to share with you. Is human capital a resource or is a cost? Because that is, if you want, quite basic, but of course, profit and loss has human capital as a cost. That's even including training, employee development. And so clearly cost is something difficult to say that is something positive. It's, the concept of cost is linked to something negative. But at the same time, it's interesting to observe that many letters of the board chairman or chairwomen or whatever indicate our people as the major resource of a company. So it is already an interesting tension between the traditional accounts and sustainability integrated reports on the other side, because there's a quite different vision of what is human capital, if it's a cost or if it's of course, a resource. So that is a preliminary dilemma. It's not the only one. I just wanted to remind you, integrated reports. Integrated reports is based, as you know, is a multi-capital type of reporting, and where you can see human capital on the right-hand side is one of the major capitals, major resources. Capital here means resources as an essential component part of corporate value creation. So in a sense, and this, of course, to underline the dilemma, the conceptual dilemma I just mentioned to you a few seconds ago with traditional accounts. Looking also the the detailed substance of human capital, I just took the example of Engie. I must say that I would like to publicly thank Professor Stéphane Trébuc, that he has the chair of human capital at the University of Bordeaux, for giving me some inputs and valuable inputs. So he was mentioning to me exactly this case of Engie. Engie produces a nice integrated report, but not many information about employees. I mean, number of employees, hires, percentage of training of employees, work study programs, nationalities, not very many more information. So the question I pose to myself is this enough to assess the human capital of a company? This is not the traditional accounts. These are integrated reports where human capital is clearly one of the major, enablers of value creation. So questions that came to my mind is that why companies disclose so few and poor, to some extent, information about their human capital and its management? And this drives me to pose myself to other two sub-questions that I would like to address with you in the next couple of minutes, two derived problems, in a sense. What do we intend by human capital? And second, are we able today to assess correctly human capital through ESG available data? So to quickly respond, trying to not to respond, but at least to highlight some of the issues contained these two sub-problems that are, of course, linked to each other. Let me provide you with the definition of human capital in the integrated reporting framework. You know, the IRC doesn't exist anymore, the IRC, the integrated reporting framework, of course, yes. That is something about competences, capabilities, experience, support of the organization, ability to understand, to implement strategy, and so on. Looking at the SASB standards, also SASB doesn't exist anymore. As you know, they're all part of the IFRS Foundation, but of course the sub-standards still are there. Human capital is more about the conditions, working conditions for employees and the company's capacity to create good working conditions, so engagement, diversity, incentives, attraction, and so on. And of course, health and safety, So in a sense, let me just try to stress this a little bit, stretch it a little bit, sorry. There are two different views, really, and definitions on human capital, in a sense. Two different, in a sense, different accents. One is about what employees can give to the organization in terms of competences, capacity to implement strategy, skills, and so on, for the value creation of the company, of course. Another one, which seems to me a bit of the opposite. As I said, I'm a little bit stretching that, but what a company can do for employees to create good working environment, diversity, gender, and so on, and health and safety, and so on. So in a sense, I found this contradiction also when I was working for EFRAG in the elaboration of the standards, you know, the European Sustainability Reporting Standards, the drafts, of course, because there always this tension. Is always difficult when you start talking about, in that context at least, about, you know, the intangibles that employees can create, can give to the company, because the general view is about what the company can do for employees, how the employees are treated by the company. So I just wanted to mention this because sometimes I think in the debate, in the international debate, these two dimensions are not necessarily well perceived. And so I must also say that there are some, of course, apart from, in addition to SASB, also other organizations that stress human capital, and they, in a sense, they provide a precise list of KPIs. One is ISO, for instance, the ISO 414, the 2019 edition, and also the WICI, the World Intellectual Capital Initiative, WICI. There are some generic KPIs on human capital, including also other sector-specific KPIs on human capitals. Here, I just mentioned the generic KPIs. And you can see already, I mean, we don't have the time to go more in detail, but believe me, it's an interesting comparison because on the left-hand side is about, of course, about the numbers of full time and so on, but it's about absenteeism, it's about, you know, health and safety, which are important elements, don't get me wrong. But on the other side, on the weak side, it's more about training, is about employee satisfaction, is about leadership, and so on. So there are, of course, some overlaps, of course. I'm not saying they're completely different, but I'm saying that the two different visions I mentioned about human capital are reflected also in the lists of KPIs available internationally. I just made a little joke here, a little, you know, game, and I said, okay, let's take one quite accepted concept of human capital in the academic literature. You have, this is Mubarak et al. 2018, but there are others, but they're more or less similar. There are 36 sub-dimensions, for instance. So it's a very articulated notion of human capital, where you have both sides, if you want, the competencies and skills, health and safety, diversity, and so on. And I try to compare this, you know, with our problems. You remember, the first one is, what do we mean by human capital? Is there an agreement in the standard setters and different standards about human capital? And of course, I tried to compare the 36 sub-dimensions of the academic definition, one of the most well-known academic definitions of human capitals, with the ISO 30414, the Integrated Reporting Framework, SASB. The result has been that none of the three standards, ISO, IRC, and SASB, cover all the sub-dimensions of the academic concept, academic view of a human capital. None of the reporting standards talk about cooperation, creativity. Complaints are not particularly well treated by the three standards. But on the other hand, I must confess that the reporting standards propose other sub-dimensions different from the 36 of Mubarak et al. Of the academic scheme, such as workforce availability, productivity, alignment, compensation, and labor relations. So, so clearly there's a mismatching between some of the academic scheme of what is human capital, but also the three major reporting standards. That though they don't show a theoretical framework used by the three reporting standards, it's not clear what is the theoretical framework. The second problem you remember is which are the sub-dimensions of human capital covered today by the reporting standards we have. So what I did is to take the 36 dimensions of Mubarak et al., which is a reference. I'm not saying there's a law, of course, but I thought it was an interesting, hopefully interesting intellectual exercise. And I included also other dimensions. And I look at Refinitiv as a database, Refinitiv, of course, that is well known. And what came out is that only 40% of the sub-dimension of human capitals quoted in the academic literature are covered by ESG dataset like Refinitiv. Anyway, even if they are covered as a topic, as a subtopic or sub-dimensions, the metrics still remain quite poor, and they are, even if they are available, employee satisfaction, for instance, is very poorly treated in Refinitiv. And some key aspects, even more interesting, some key aspects of human capital, such as education, skills, creativity, remain not documented in an ESG dataset like Refinitiv. Just a food for thought. I don't have an answer to that. So going to sort of some conclusions. Clearly, there's lots of work still to be done. There doesn't seem to be a scientific-based view of human capital, what we mean by human capital. Even in integrated reporting framework that aspires to be more comprehensive. And also, even we saw that some of the integrated reports are not particularly rich in information about human capital. So we need to have a more consensual and exhaustive understanding of human capital, especially how human capital creates or destroys value, also based on both academic research and professional financial analyst experience. Both sides, I think, should somehow gather together to create a framework that can be what we mean by human capital, which are the most relevant information. Companies, clearly might be reluctant. We know that they may consider these issues sensitive or hypersensitive, like skills, personality, employability, sustainable employment, and so on. Maybe it's a time, just an idea, to launch a global human capital disclosure project if we want to enhance the quality of information in this field. And also to avoid what has just been said in the previous panel, so the fragmentation of regional fragmentation, standard setters linked fragmentation. So in order to avoid on this such an important fundamental issue, that each of the standard setters, each of the main regions around the world create its own, standard information on human capital that will make things worse and worse. I understand that in the current geopolitical situation, this might sound like I have a dream type of sentence, but I think if we want to progress in this area of ESG information and intangibles linked information, I think we need to study maybe a common global project. Thank you very much for your attention.
Thank you very much, Stefano, for this great, very clear and structured introduction, very useful. I think that if you agree, we will have the pleasure to share your presentation to all the participants, and you will find it I do speak under your control, Stefano, and the organization, but I think it will be useful for everyone. We realize that human capital is a complex issue, but when we address sustainability, we have to assume complexity. That's part of the game. And now I let the floor to Walter, how he does address, as an investor perspective, this complexity. Thank you, Walter.
Thank you very much. I'm glad for being here, and thank you, Stefano, for pointing out the complexity, as said. And there are two ways to go to deal with the complexity. So either way, you just ignore the whole issue, or you dig for more information as you proposed, and which I find very positive. When we remind ourselves of a very recent Economist article, which was about ESG investments, is ESG dead? It's too complicated, we should reduce it. So they went a completely different direction. And their opinion was, we have one major issue in the world, this is climate change. So just make ESG E, and E is even still complicated, just focus on emissions. This was the proposal. And instead of having the world as complicated as it is, like Pippi Longstocking, make it as we want it. And we see some big players, some big, very influential persons in the industry, in the market, that see it the same way. Let's think about Elon Musk. he was quite upset when he got informed that his company, Tesla, is going to be kicked out of a sustainability index. How is that possible? He's saving the world by producing electric vehicles. Who would care about the circumstances in his factories? Who would care about discrimination, how they're handling pregnant women? Well, they're still producing electric vehicles, right? So there is a big emotional debate happening, and we see it also in the US, the Republicans taking the side a little bit of Elon Musk, and especially in some states, they have been very offensive in that regard. They see ESG as a movement, a socialist movement, which is contradicting the free market. And how do you best show the dislike of ESG investors and the practice of excluding companies? You boycott companies that are boycotting companies. This was just quite a funny move by Texas and some other states. They started boycotting asset managers who are excluding companies. And coming back to what we've heard in the panel before, there's active ownership still there. And funny thing is, it's not just the Democrats, it's not just people who have ethical values who believe the social pillar is important. It's the shareholders, and there were a lot of shareholder proposals at Tesla's shareholder meeting. So obviously, it's Tesla's own shareholders who believe it is important how people are treated. It is important to fulfill some minimum social standards, and without any ethical motivation, from my point of view, this totally makes sense. Let's look at the labor market. It's quite tense. It's not easy to get new laborers, new talents, and of course you're better off when you're well positioned as an employer. And we've seen these many dimensions of human capital. So if you can position, and I would take the SESB perspective, what is the company able to provide to its employees? If you're better positioned in that regard, of course, it's easier to retain your employees. It's easier to attract new talents, which is very important in current situation. And the other thing is, if you invest into your employees, if you safeguard some social standards and some that accidents won't happen at your factory, of course, the quality of your products will also be better, and on a longer time perspective, you're better off. So to sum it up, without any political motivation, I see a strong financial materiality in looking at the social factor in each industry, and this makes it different from emissions, for instance. Emissions are not financial material in every industry. The CO2 emissions of a bank are not relevant from an investor perspective. It's relevant what they are financing, but it's not relevant. They are so small, it's not relevant what they are emissioning. It's different with social factors that's relevant for every industry, in my opinion.
Thank you, Walter. So after the investor point of view and the academic one, I let the floor to Daniela for the corporate point of view. Thank you, Daniela.
Okay, thank you very much for inviting me. Schönen guten Tag to the audience. Okay, I will be projecting some slide if I manage. Do you see my slide?
You're mute. Daniela, we see your slides, but you're mute now.
Can I see it? Let me see.
We can hear you now again, but the slide is small.
Yeah, but I mean, as we hear you, I propose that you, that's the most important thing, that we listen to you, and we will share your if you agree.
Okay,
Your slide
sorry. Now
no
I
problem,
see.
please.
Okay. So thank you very much for inviting me, and I am very honored to be part of this panel. Okay, you see my slides. You don't see my screen, correct?
Yes.
Okay, thank you. Okay, so my topic has to do with human capital from a corporate perspective. It's very interesting, was said before by Stefano and Walter. In my case, I am okay, I started asking myself what the title of the seminar, Human Capital at the Art of ESG is Intangible. And as a matter of fact, human capital is very relevant because it's human capital has to do with the internal relevant stakeholder. But it's also connected with, it's a very important intangible asset in the company. It has to do with relational capital, it has to do with intellectual capital, and it has also to do with governance. Okay, so the topic is, I think that the dilemmas with which Stefano was proposing, cost and revenues, and also the different treatment of employees, what employees can give to a company and what the company company can give to employees, can be actually put together, combined together in the fact that from the ESG perspective originally, we were looking at the risk factors of, which we are dealing with stakeholders. And from an ESG perspective, the human capital has to do with employees, but has to do also with all the relevant external shareholders, which are relevant external stakeholders, which are the stakeholders, the top management, clients, suppliers, the local community. And we can analyze positive KPIs to consider, the human capital, and negative KPIs. We can focus on, what the company does for the employees in terms of welfare, in terms of a good working climate, work-life balance, how the company invests in training of the employees, and also how much, which is the employee satisfaction. I mean, how the employee feels part of, part of the corporate mission and vision, and are, they have a strong corporate identity. And this can be looked and translated from a corporate perspective into understanding which is the turnover as a KPI and the reputation. It is from, if we look at these, negative KPIs to consider human capitals, then we are focusing on health and safety, diversity, equity in the pay treatment, the gender pay gap, negative impact on the community, but also it's connected with the environment, so the relation with the natural capital. And of course, there are issues of social washing because, normally companies, when they are reporting, they try, to say the best, not the worst of themselves. From a corporate perspective, however, human capital, it was already mentioned several times, is very, very important because, of course, it has to do with all the very relevant capital of the companies. And of course, it's basic. Human capital has to do with top management, with the governance of the company, with the organization, has to do with the organization and the structure and the organigram of the employees. So normally companies, so we have to probably to distinguish between large caps, large enterprises, which are listed in major international indices, and SMEs, middle and small enterprises. If you're speaking with an entrepreneur which is representing SMEs, they are really thinking they're doing the best for the employees. They are very focused on human capital, and they are very focused on welfare, relations also with, keeping a good relation with the community, because normally they have quite a strong relation with the local communities. Whereas when you are speaking with the top management of a large enterprises, large listed enterprises, a multinational, with the operation and site spread all around the world, normally they are very much focused on compliance and on keeping under the site the negative KPIs. Of course, it depends on the kind of activities. I mean, if you are on a manufacturing activity, or if you are in a sector, operating in a sector where health and safety issues as well as environmental are very strong, then of course you have a lot of negatives indicators which you have to keep under control, and these kind of indicators are also difficult to be interpreted by financial analysts, because you have to connect them, and sometimes ESG rating providers, they give you a picture which is you have to really to interpret. One very important last point has to do with diversity and innovation. The kind of speech which is prevailing nowadays, particularly in large enterprises, has to do with diversity, but particularly gender diversity. Whereas I would say that diversity has to be connected strongly with innovation. And some way you have to focus much more on competence, the mixture of competence within the company, among the employees, at the board level, rather than gender diversity. Of course, gender diversity is relevant, but I would say that it's important more to focus on gender from an equity perspective, and and offering equal possibility of empowerment. But the mix of competence, the diversity is strongly correlated with innovation and innovation mentality within a company. Okay, now let me, I also was reflecting of integrated reporting model, and as a matter of fact, let me remind that in 2007, I was part of the EFFAS ESG Commission meeting in Vienna, so 15 years ago, where Paul Druckmann, today he is head of the World Benchmarking Alliance, he was presented the Integrated Reporting Initiative. So actually, EFFAS was at the very start of that initiative. And in this model, of course, you see, and it has been already quoted, that you have a strong connection, interrelation between human capital, which has to do with also with social and relational capital. It has to do with intellectual capital. It has to do with natural capital. The work-life balance, the environment, etc. And of course, is connected with financial manufacturing capital. the governance side has to do a lot with human capital as well. Okay, now let me switch to some indicators, some KPIs. I mean, these are taken from different companies. You see, for instance, the breakdown of the employees by category and also by gender. And you can see, I mean, if you look at these indicators, you can take some assumption and also you can take some conclusion. You can also see how many of these employees are temporary or how many of these employees have a fixed contract. Then a very important indicator also to understand the has to do with the employee satisfaction is the turnover rate. The turnover rate has to do with, you know, how employees, you can calculate in different way, but you can focus on the exit, on the, you know, divided by the average employee numbers, but you can also look at the overall employees rate. Anyway, a company which is growing pretty fast, of course, has a lot of employees who are entering, but if you are seeing that a lot of employees are also exiting the company, you may deduct that there are some issues. And if you make a breakdown by gender and by age group, then you can take other conclusions. Of course, it's very important also the health and safety indicators and to analyze the kind of injuries and to, you know, to analyze them relative to the number of employees and also analyze the different, one topic which is also important, there are a lot of often in the infrastructure or in large projects, you are involving a lot of suppliers and you have accident of the suppliers, which sometimes are not reported, but they should also be reported and taken into considerations. Now, the company gender pay gap, as I told you, has to do with equity. Some way in the UK, companies, listed companies, to disclose the gender pay gap. Here you see an example of a company which is pretty, I would say, balanced. You have among executives just 1% gender pay gap. So women are paid 90% of men. In the mid managers, it's a little bit higher, and among clerks, it's more contained.
Daniela, thank you for all these very concrete examples, but you know, today I'm the bad guy. I have to keep on time.
Yes, sure.
May I ask you to conclude this introduction before we move to other questions? Sorry for the...
No, don't worry. I mean, I was just projecting some indicators in order to see how the companies. I mean, with the SFDR legislation, etc., companies now have to focus and to calculate which is the turnover and the Kpis and the Ops, which are according to the eligible pursuant to the European taxonomy. So I would say that companies now, those who are under the radar of, you know, they are not small companies, but under the radar of this legislation and are invested by investors who needs this data according to the SFDR regulations, they have quite a lot of difficulties because really they have to understand how the taxonomy eligible are they, you know, the revenues, the capital expenditures, and the operational expenditure. What is very important, however, from a company perspective, is that all these ESG data are integrated and are also considered in the strategic business plan. If they are not integrated into the strategic business plan, you know, little by little, it will be very difficult to organize and drive their activity to grow their percentage of turnover, Kpis and Ops under the European taxonomy. So let me conclude it this way. Thank you.
Thank you very much, Daniela. I would like to start with the first question, which is a question of data. I mean, all the day long there is this question, but keep in mind, I had the chance also to be in this field for the last 20 years, and positively we've seen a lot of progress regarding data for the environment field and governance one, but clearly social is still the poor parent in terms of data reporting and quality, whatever we think about quantitative and qualitative data. I can also tell you that because I'm a portfolio manager of a global equity fund named Human Capital, so I'm clearly concerned by that. And at the same time, I can guarantee you the long-term performance of organizations, corporates, but also countries, when they deal with and manage well human capital. But we investors, we still have the question to have access to data in terms of quality and quantity. So you three, do you see some improvements, how we could get more information? Do you have some solutions, recommendations to express right now? I start perhaps with Walter.
Yeah, so we already had the topic before that there is a very diverse approach to ESG. We have different ESG rating providers and they have the different approaches, and there are quite a lot of people asking to standardize it in a way. And first we have to think, I would say, about the two different layers of information rating providers provide. One is the score, the rating itself, but the other thing, and here I see a strong value in diversity. As long as you know the general framework of the rating agency, where they're coming from, when were they founded, and there are two very explicit examples. We have ISS, for instance, on the one hand side, which was formerly ÖCOM, founded by religious organizations, so obviously they have an ethical background. And you have to take that into consideration when you use the information. On the other side of the spectrum, we have MSCI. They have a risk-driven background, and they see ESG from a risk perspective. And this is sometimes different, and we should, if we would standardize, you would need to go for either way of those two examples and say, that's the way it needs to be done. And I see a strong value in the diversity, and as said, especially for active fund managers, and there's a strong value in doing your own analysis. It would not be necessary if all the information is standardized. The second layer is the exclusion screening. So rating agencies are also screening if a company is breaching the ILO standards, for instance. And there's a very defined, very precise framework what the ILO standards are. And there I would expect that rating agencies, independent of the background, have the same opinion. And we see that sometimes information is faster for the one than the other, but in general, when it comes to exclusion screening, we see that there's quite some standardization already available.
Thank you. Stefano, you did a proposal, having an initiative on human capital, which will certainly have a part regarding to have more data. Do you have other remarks to do regarding this key issue, the access to data?
Thank you, Jean-Philippe. I personally think that with using expressions, it might be a little bit strong, that financial analysts can change the world. In the sense that I always believe that, I see my colleague that is smiling, but it's not an exaggeration, because the fact that you have contacts with companies, you can request for some data, you can have new ratios beyond the financial ones, where you put together financial, non-financial information, and you ask for them. EFFAS together with CFA would have an incredible potential to ask to produce a framework that can be shared between the two major initiatives, international initiatives from financial analysts. I know that there's Fritz Mossberg on the first row there. So I think that financial analysts should take a more proactive approach. and you know, asking for more information within a coherent and consistent framework that can be proposed easily to IFRS Foundation, that can be proposed to EFRAG, because of course, after all, you are the major users of this type of information, and I think it's a little bit in your own interest, you know, in our own interest.
Yes, thank you, Stefano, to remind our responsibility, and I completely agree. And we spend a lot of time by discussing directly with corporates why it is important, why we need social data, why we need data on turnover, safety, trainings, and so on. And really, that's something that we have to keep in mind.
Yeah, exactly. And after, because human capital becomes organizational capital, and then you know, sorry, I'm talking the language not of ESG in this moment, but the intangibles. And organizational capital is the major lever for value creation over time. So in a sense, there's plenty of room for initiative from the financial analysts. ISB, the International Accounting Standards Board, has declared to 2024 there will be a major project on intangibles. ESG, we don't have to present ESG, the importance of ESG around the world. So I think financial analysts there's plenty of room for a great initiative that can be labeled as you like, both sides, CFA and EFFAS. I don't think the time is the time of division, but it's the time of collaboration here. And so once it's clear to corporates that you can have different ratios, not the only return risk type of ratios, but of course the ratios and the information can be used also in a different way and different perspective, including human capital, of course, also by financial analysts. I think this can change radically the attitude of corporates. So I really encourage EFFAS and the top EFFAS people to consider this as a possibility.
Thank you, Stefano. Daniela, some remarks regarding this question of data, social data?
Yes. Okay. Social data are more than environmental data, qualitative. You know, so I have shown you some indicators which are turning social data into quantitative indicators. So we have to use as much as possible those indicators which are released in the annual report on employees, that there are a lot of data released, or on the integrated reporting or the non-financial disclosure, etc., the sustainability reporting, which are quantitative. But we have to combine those data with an understanding which was proposed by the scheme of Stefano, and by the, using those software elements, which we can, how can we evaluate, or where we can source these elements? Well, there are some databases. For instance, let me quote one, which is not has been quoted, which is RepRisk, which giving you the indication of the reputational risk on a lot of topics, social topics, human rights, labor rights, respect of diversity, etc. So there are a lot of indicators which are collecting information from local community as well as international press and NGOs. So the topic is the topic is also, you as an analyst, you can make a researcher yourself, and if you list some of the topics there are reputational risk, then you can scout them. And if a company is affected by social washing, and I was telling you before, that is presenting itself in the wonderful way, whereas there are topics, issues here and there which are not mentioned or are mentioned in a way and are not addressed in a way where you are trying to find solutions, then this is of course a risk. And this is a risk which is affecting the financial market. So we have to cope with what we have so far. That is quantitative data, those which we have, qualitative indicators or flags of risk, which combined with those data give you a picture And so that's the reason why I'm saying, and I am sharing the view of the other colleagues who are speaking before, that we have to use artificial intelligence, database, etc., but we have also to use the capability and understanding of financial analysts in evaluating this data and combining qualitative and quantitative.
Thank you, Daniela. Before moving to the Q&A sessions, I have a last question for our participants, for our speakers. There are today a lot of news flow and dynamics. For instance, you probably heard about the great resignation debate in the US, with a lot of people leaving their jobs, something like 40, 50 million just in 2021 and again in 2022. But also the evolution of the way we work, with a lot of work at home today, or potential social taxonomy in the EU, or even the debate regarding some sensitive supply chain, such as textile, just to give an example. So starting with Walter, would you like to emphasize one key point, one key event you have in mind with all the news flow we have today?
Sure. I would just like to add, I was smiling before. It was great to hear Professor stating that ESG can change the world. Usually there's also here some arguments there. So thanks a lot for finding that out. I totally agree. What are the major topics nowadays? We see in the European Union, just some days ago, there are new regulations coming up that you have to take care about your supply chain. Some years back, we were all happy to not see it and not look at it, and as long as it is cheap and you get it in time, all is fine. And ESG investment started to also look at supply chains, and this is now becoming a regulatory topic. So supply chain management will become more and more of a concern, especially with the vigorous situation in Xinjiang in China, and what we were told by this latest UN report. On the other side, we have this new style of working, this home office, which is becoming more and more a standard in companies. And here I see the risk. On the one hand side, you have to provide it to new employees. That's more or less, if you want to attain talents, you have to also offer them home office. But the risk is, if you don't get people back to office at all, they won't make the strong connection to the company like they used before. So usually when you join a company, so you join the company, but you leave your colleagues. And if you don't get to know your colleagues, it's quite easy to move to the next company. So see here the big risk if we don't get people, and I would not force them, incentivize them to come to office, that there will be higher fluctuations than we were used to see.
Thank you. Stefano, do you have one event, one dynamic social one that you would like to emphasize?
Well, just a bit of a slogan, if you want. But if we want to understand the value creation over time, not only the profit, the year profit, but the value creation capacity of a company, we need to expand our vision of what is a risk. This has been said, of course, already also at the previous panel. And we need to consider at the same time ESG aspects and intangibles. And I would like to launch this idea of ESGI, where I stands for intangibles, because in a sense, unless the two things are considered together, we miss an important element of value creation of a company.
Yes, just to go in your direction, when we think about intangibles, we think about education, and that's really a key enabler for ESG, whatever the subject. Thank you, Stefano. And Daniela, one event or news flow you would like to emphasize?
Okay, I agree completely with what was said. I think that smart working is smart so far. It doesn't become an habit. And it would make sense probably to combine the two in the sense that having a mixture, more flexibility would be fine. But I would like anyway to see that there is the fact that human capital is so important, the employee satisfaction rate. If you have such a high rate of people leaving, it means that these people are not part of the corporate identity. So there is probably, you know, with such an extreme event like the pandemic, COVID, of course, the values have changed. But the fact that you don't feel connected to your company anymore, it's quite an indicator which is not good. Also, I would add the protest by employees, young employees and trainees of Goldman and Sachs, or big investment banks, which last year, 2 years ago, were complaining for the the very long days of work. So sometimes really you have in France probably the debate of the shorter week, etc. I think these are all topics which are delicate to be tackled by the politicians, but they are an indicator when you do an analysis, both for entrepreneurs and or top managers and shareholders as well.
Thank you, Daniela. The next step, is that we are going to have the lunch, so it's terrific timing, and how food is important for a French person like me. But we have, please, some minutes if you have some questions, if you want to react to the great contribution we got from our three panelists. Yes, thank you.
Thank you very much. Maybe only one small remark from my side. I think to disclose data regarding human capital or some social data is very important, and I really support that. But when I'm reading on slides to disclose some creativity, personality, or such sensitive parts, I'm wondering, how can I calculate that? How can I evaluate that? How can I put it in quantitative KPIs? Because especially for financial analysts, for asset managers, this is important to have some quantitative numbers on that. And then in the second step, I'm really wondering, yes, data are very, very interesting for analyzing, but is that really important for the market? Is that really important for the investors? Are there not more important social topics under human capital? So what I really liked at the beginning was some kind of double materiality. So what does the company do for the employees, and what can the employees do for the company? And I think this is for me the essential part, and we really should keep it short and request for data which you can fill in with also with some quantitative numbers.
I think we all agree, and thank you for your contribution. Really, really.
Yeah.
Okay, so I have the pleasure to stop right now and to invite you to the lunch, and I would like to thank you very much, our panelists.
Schalten Sie Alex zu. Schalten Sie ihn zu. Ah, okay. Hallo Alex. So, yeah. So, I welcome you all back from lunch. I hope you had a nice lunch break and did use the time for networking and conversation, because that's also the other part of the ESG conference. And I would like to welcome you all back, and we have a very important topic, the CESG 3.0, where do we go from here? And I think Fritz Mossberg this morning at the welcome already elaborated about how successful the EFFAS program was developed in the last few years, and that we have more than 500 people doing this sort of examination on a quarterly basis, and more than 3,000 people being involved. And who else could be the better person of giving us an idea hear about this was developing in the last few years and where are we right now and how do we go forward than Professor Alex Bassen. And he, from the very beginning, is the academic director of the EFFAS CESG program. And Alex, we just elaborated that a decade ago, we were all sitting in Berlin over the weekend and having a kickoff for this, also with René and Gunnar. And so I really like to welcome you. And ladies and gentlemen, Alexander Bassen is a full professor of capital markets and management at the University of Hamburg. And he is also member of the German Council for Sustainable Development. This is the advisory body of the German federal government. And he has also served as a member of the EFRAG project task force on the EU level. And besides his capacity at the University of Hamburg, he is also an honorary research associate at the University of Oxford and a visiting professor at the Hong Kong University. So I think, Alex, with this, I've prepared the ground, and I'm really glad that we have you here and you could spare time between your sessions so that you can give us an update about what is the CESG program all about and how do we go from here and driving it even more successful in the next few years. Please, the floor is yours.
Yeah, thanks a lot, Frank, for the nice introduction. As I am right now in Berlin, I also thought about what we did here 10 years ago with you, René, Gunnar, Henrik, Frank. So a lot of people were already involved there, and I saw Gunnar and René on the agenda. So very happy to be here today and to describe what we are doing with CESG, where we are right now, and what will be the next steps. So what we are, you know that we started the CESG as a program which is dedicated to investors, investment professionals, and that of course the pressure increased in the last couple of years with the EU regulation, not only the one you mentioned already with the NFDR and the CSRD, but also of course the SFDR, Sustainable Finance Disclosure Regulation. So we focus on ESG data, on the question of reporting, also the focus on different asset classes, and the due diligence process. I just want to briefly summarize what the advantages are. When we started 10 years ago, it was one of the first programs, probably the first program. And at the beginning, it was really tough for EFFAS. So I'm very happy that EFFAS supported the program all the time. Even if the numbers were at the beginning not as high as what you just mentioned, Frank. So the idea was that we use academic findings for it. We are cooperating with practitioners. So there are a lot of practitioners involved in this program because we want to give an incentive and also support for making decisions in the integration of ESG. So that's why we thought it's important to have an online program, that it's recorded, that we have slides available, that we have a platform that EFFAS provided, and also the national member societies are providing. We also have online exams right now. At the beginning, we only had in-class exams, but due to COVID, now we are very familiar with online exams. So it's really customized to the needs of practitioners. And what did we change in the last year or so? The structure remains pretty much the same. So I would say we have this first 5 modules, which are, for those of you who participated already, and Fritz, I know you did, so therefore you know the program as well. We start with a general introduction, what are the recent developments. Then we have a dedicated topic to regulatory environment. So every regulatory changes, especially on an EU level, but also internationally, if you think about the ISSB development, the reporting requirement of the SEC, this is all in the module number 2. And we put it in one module because actually it's much easier to update just one module where you have all the regulation integrated. Then I would say the usual suspect ESG strategies. And from the beginning, we said it's important to not only look at equity, but also at other asset classes. So we have dedicated module to all the asset classes that are relevant for ESG integration. Then ESG reporting, what we think is important. It's also the first step to the due diligence, so the ESG integration. Because if you want to integrate ESG in research, of course you do need to understand what a company is reporting, and not only use the databases, which are also very helpful, of course. Then ESG integration, and then the investment process chain. And what we changed is also in 3.0 already, that we have the case study, the company analysis, the case study, which is based on module 6 to 7, but we also have a portfolio management case study, which is new. So we integrated this module number 8 with the ESG integration, the investment process, also with the case study. So, and plus what is new right now in the modules number 10 is that we also cover the ESG regional developments. We did that for Asia Pacific already 2 years ago. We have a new one for Latin America and also for North America, because actually EFFAS started with a, of course, European perspective and focus, but a lot of these aspects are globally relevant, and most of you are global investors. So therefore, we think that it's important to have this complementary modules on the different regions, so Asia, Latin, and North America. All right. So right now we are still in the process of an update. So we have a new module or a new update, CESG 3.1 for the Q4 this year, will be relevant for the exam March 2020 with this new, as I just said before, Latin and North America complementary module. We also started a cooperation with Clarity AI, where our participants have access so that they can work with the database. And we also integrated that into the case study just to give them a feeling of how to work with the data and how to integrate it in the case study. So free of charge access to the CESG participants and the CESG holders after they finish their exams. So just one example. Of course, we also integrated the other data provider with examples. So we have MSCI, Sustainalytics, ISS, ESG, you name it, they are all integrated in terms of slides. So we are not focused, of course, not focused on one data provider. So about the exam, we do not have that much changes in terms of the exam. We still have the multiple choice questions, so 20 multiple choice question. We have one case study with 9 open questions and 6 weeks free trial to Clarity AI app. And we have now, you mentioned that as well, 4 exam sessions every year, and 4 exam sessions every year. And it's really kind of overwhelming how open the market is right now for this program. I would also like to show you some figures, how attractive the program became in terms of the educational level. You can still see a lot of participants already have a master's degree, and age is between 30 and 39 or up to 49. So also a lot of younger or also senior people who participated in the program. And I think this is also our feeling that it's an advantage. You can enter to the program even if you do not have that much knowledge on ESG, but also for those of you who are advanced, if you go to the analysis, the corporate analysis, or the portfolio management, you will see a lot of new components or in terms of engagement, which you can use for your daily work. I just received an email from Singapore, from a participant from Singapore who said, well, he has his first engagement activity next week. And he said what he learned in the CESG is extremely helpful for what he has to do next week. So that was a really nice feedback. And if you look at the professions, you do see that we have a very strong focus on asset management, portfolio management, financial advisory. So those who can really use the CESG information for their daily work. 3,500 already from 78 countries. And I think this shows how international the program is. That was If you look, of course, Spain and Germany are the most important countries. But number 3, and I think that's quite interesting, is Hong Kong. Why Hong Kong? Not only because I'm teaching there, of course, but EFFAS has a cooperation with Friends of the Earth in Hong Kong to start the program also there. And within 2 years, you can see we have 443 CESG holder already in Hong Kong. So very attractive there. And we also started 2 weeks ago a cooperation in Singapore. So that means that CESG will also be promoted and offered in Singapore to further develop the Asian market. Because also there, of course, is a very high need for education in that field. Yeah, here, just based on the map, it's Germany and Spain and also France. So still, of course, a very strong European focus. Also Switzerland. René, if you're still there, also Switzerland is a very important country for CESG, and I'm very happy about that because we got a lot of feedback, very constructive feedback from Switzerland. Also, this is very important for us. So if we are updating the program, we are doing that based on what we are reading, but of course also on the feedback of the participants. So this is always very, very welcome to receive that feedback. And we are integrating this feedback into the version 3.1 we do have right now. And I have to say, next year, of course, we will also deliver a new version 4.0. Because in the field of ESG, it's almost impossible to change the slide, record the videos, and still be up to date with the development. So therefore, it's really necessary to update it every year and to have a complete new setup, at least I would say every 2 years, with all the videos, slides, and questions, and everything that is related to that. So on the platform, we also have a lot of, couple of hundreds of exercise questions for the multiple choice questions. So, and of course, also they need to be updated. So it really became quite complex, the whole program of CESG. And but what you can see here also very successful. Here the distribution globally from 2014 to 2022, 72% is Europe, then already 15% Asia. And I think that's really a success, and it really shows that what we did here is something that is globally applicable, which is not only interesting for the perspective of the participants in these regions, so in Asia. I think it's also interesting for the European participants because you know what you will learn here at the CESG is globally relevant, and with these global modules, number 10 for South and North America and Asia, I think we really provide a quite comprehensive overview combined with the different techniques in the other modules. All right. In addition to that, and I think this is something you're also familiar with, we do have individual company trainings. So a lot of banks, also some insurance companies use CESG for in-house training. Also, this is something that is applicable. And here's just a list of those companies who are using the CESG training for their employees. It's not the complete list. So if you say, well, we are using it as well, we are not on the list, this is possible. This is just a screenshot of some of the players in the market. I mean, we do not have to discuss that this is a very important trend. We just have some screenshot here, how media picks up the ESG certificates and also the, especially the CESG program. By the way, also in Asia, the coverage, the media coverage of CESG is quite high. So there are TV interviews, there are other media coverages. So the need and also the acceptance is quite high right now. So therefore, we're also quite positive that besides Hong Kong, also Asia, also Singapore will become an important market in the near future. So if you are looking for any additional information, I can recommend, of course, the EFFAS website. And the platform you do have there as a CESG holder, if you subscribe to the program, you have access to, as you said, the videos, the multiple choice questions, and also the slides. And if you have any further questions, do not hesitate to contact the EFFAS office. They're more than happy to support you, but also your national member societies are there to support your work. So thank you very much for your attention. And if there are any further questions, I'm more than happy to answer those questions. If you have any question in terms of how should I prepare for the exam, you could just ask Fritz, because he's very experienced in that as well. So thank you very much for your attention.
Are there any questions from the room here in Vienna? Yeah, Alex, I don't know whether you see it. There's a common word. Sorry, you forgot the CESG holders from Principality of Andorra. So you see,
I cannot. I'm very sorry for that.
So we will include this in the pie chart next year.
Okay, then we have 79 countries, not 78. Sorry for that. We will make the 80 this year. I'm pretty sure.
Great. Yeah, Alex, thank you very much for the input, and success is widespread. So we keep our fingers crossed that we can continue this road, and we are really glad that you are participating and that the rollout for 23 is already on the line and ongoing. And I think the last quarterly data point all in the right direction. So thank you very much for your effort.
Yeah, thank you for your invitation, and thanks to all of you for participating in CESG, and enjoy the rest of the conference. Thanks a lot.
All the best. Thanks, Alex. So I think now you got the first remark about how to go forward with that. And as I said, as we elaborated this morning already, training in this environment will be really vital going forward. And I think EFFAS is really on the forefront, and we are going to develop the program on an annual basis and also expanding it geographically where this is necessary. Now I would like to come to the next point of the agenda, which is what is going on in carbon markets. And I'm just wondering, yeah, Leo's already there. Great. Leo, can you hear us?
Yes, I can.
Great.
Hi, everyone.
Thanks a lot for having you. Leo Mongrende is the Senior Manager at KPMG International. And besides that, he's also the carbon pricing and market lead of KPMG's Global Decarbonization Hub. And he has more than 15 years experience in this very interesting field. And he has a lot of experience with including carbon project development and also with Article 6 transaction under Paris alignment background and advising large international corporations on their net zero strategy. We all know that this is even more important going forwards, direction 2030 and 40. And last but not least, also to secure long-term supply of high-quality credits. And Leo, we are glad to have you here and give us a bit of an insight what is going on in that market, which was largely neglected for a long period of time. Also the price development of carbon. But I think the last 2 years have been shown really spurring this development and especially the interest in the carbon markets. So I think therefore, as carbon reduction is the name of the game and will be the name of the game of the E in ESG going forward, especially taking all the net zero initiatives into consideration, you are ideally suited to give us sort of an idea what's going on and what do we have to take care about. So please give us a heads up.
Thank you very much, and good afternoon. Hi, everyone. Yeah, let's talk about carbon market and carbon pricing instruments. So I will skip, sorry. I'll skip the introduction and go straight to the menu of this session. So obviously, like covering carbon market and carbon pricing instrument in 30 minutes is a bit of a wishful thinking. So I casted the net pretty wide, and I will provide some insight and latest trend on all the various like declination of carbon pricing instruments. Some aspects, I guess, will be maybe trivial or easy for some of you, so bear with me, but I'm pretty convinced that everyone will learn at least something today. So we'll start with some introduction on carbon pricing instrument, talk about ETS and carbon tax schemes, latest developments, talk about internal carbon pricing, carbon crediting mechanism, and then obviously the voluntary carbon market, which is making quite the headlines for the past 2-3 years. And I'd like to finish that session with a few concepts that I'd like to share with you because I'm discussing this very often with clients and colleagues. So let's get started. First, why carbon pricing and why pricing carbon is necessary? And I guess this question is becoming is answering itself like more and more, especially after the summer that we've gone through with you know, massive drought, heat waves, wildfires, and all. So it's quite clear now in 2022 that CO2 emissions are negative externality, and it's important to consider integrate them in any investment decision. Carbon pricing is also important for achieving the goal that we set for us and we agreed upon when it comes to the Paris Agreement and, you know, limiting the global warming. It's important to stimulate investment in clean technology, and last but not least, it's also a massive source of revenues for government and states. So to give you a sense, like all CPI combined in 2021 managed to generate $84 billion US dollars, so quite significant. So when it comes to the pricing instrument available, I guess we can split them in 4 main categories: carbon taxes, ETS, internal carbon pricing, and crediting mechanism. The first two, carbon taxes and ETS, are typically regional, national, and subnational. They are different in nature and design. Carbon taxes will be designed by government that will set the rules in terms of what will be the coverage and decide on like a price point, and then after the market will dictate the level of emission reduction that will be achieved. Obviously, there is a clear incentive for companies and entities within the mandate of the carbon tax to reduce, to pay less tax at the end of the day. ETS, also called cap and trades, work a bit differently. The government also decide on the sector that will be covered as well as the total emission that should be emitted. And then companies within the scope of the ETS can emit their free allowances, but if they emit more, they need to procure allowances through auction or through trading with other companies that are them emitting less. So there is also a good incentive here. When it comes to internal carbon pricing, this is mostly you know, a mechanism that's implemented by companies as a way to well, put a price on carbon and take that into consideration and drive positive change. So the reason for implementing internal carbon pricing are many, mostly to reduce emission, of course, to estimate climate risk going forward, to future-proof companies, and also for very likely upcoming disclosure requirements. ICPs at the moment come in roughly 2 flavors: shadow cost, which is essentially the company will agree on an internal carbon price, but this will be theoretical. There won't be any transaction within the company, but rather use that as a way to evaluate and assess future investment, for instance, to consider the externality into the decision making. The other flavor is internal tax, fees, levy or trading system, and in that case there is actual transaction, and the proceeds of this transaction is usually earmarked for decarbonization purposes, for instance. Last but not least, carbon crediting mechanism, which is by nature either like national or international, are mechanisms that are designed to reduce GHG emission. They are usually governed by standards and methodologies that are doing GHG accounting between a baseline scenario and a project scenario, and estimates the volume of GHG, carbon emissions, either like reduced or sequester, and issue credits accordingly. They can be, as I said, like national. So UK Woodland Code is, for instance, an example, or international. Everyone has heard of Article 6 of the Paris Agreement. The voluntary carbon market is also another international example. Question: are the current carbon pricing instruments sufficient? The short answer is no. At this point in time, we only have roughly a quarter of global emission currently covered by some form of CPI. The good news, the relatively good news, is that the trend is clearly on the up, and there is a growing share of these emissions that are covered, and this share has tripled in the last decade. So you've seen that little visual, the number, both the coverage and the number of CPI being implemented globally. Next question is, are the prices currently applied high enough? And while we are seeing clearly an upward trend, especially when looking at like the voluntary carbon market, for instance, that is booming and growing in a crazy fashion, the prices are still too low to be meaningful. At this point in time, we only have about 4% of the share of global emission that is currently covered by a carbon price that will fall within an appropriate range. And by appropriate range, I refer to the carbon price corridor that was established by the High Commission on Carbon Prices, that's being led by Stern and Stiglitz, and essentially established that if we are to meet the Paris Agreement target, carbon prices should be ranging anywhere between $50 and $100 a ton by 2030, and that's like further supported by the IMF, that's advocating a carbon price of $75 a ton by the end of the decade. Few words on ETS and carbon taxes scheme. So this is a very nice map that I borrowed from, by the way, the World Bank State and Trends report on carbon pricing 2022. If you haven't read this report, I'm convinced that like some of you are well aware of it, but if you haven't, like, please have a read. I contributed personally in the development of the 2021 version, and I think like this map is telling everything and shows exactly where the various instruments are being implemented. Europe is a bit on the leading edge in terms of coverage, in terms of complexity in the various schemes that are operating in parallel. Last year, and this year actually, a limited number of CPI have emerged. I think 4, if I'm not mistaken, and there are so 68 in currently ongoing, and 3 that are planned and scheduled for implementation, actually including 1, if I'm not mistaken, in Austria. I think like the main large development, every development is a step in the right direction, but I think one of the main and most notable developments in the recent years is the implementation of the Chinese ETS, which, given the sheer scale of the country and emission covered, has become de facto the largest carbon market when it comes to emission covered. So this is definitely a good step. Few words on the EU ETS. This is the longest lasting such ETS scheme, and also the largest market by traded value. Last year, 15 billion EUAs were traded on the IC, the largest secondary market platform. We reach record high prices in 2022. I believe the record was 98 euro a ton in August, so quite recently. And in 2021, revenue generated by this scheme alone was valued at $34 billion. So the EU ETS is covering the largest emitting sectors in the EU, which are electricity and heavy industry, emission-intensive industry. and sectors, as well as aviation for intra-European Union flight only. There are some talks in strengthening the EU ETS for like further coverage, including in the maritime sector, so taking maritime sector into consideration and building new ETS for building and road transport fuels. In addition, and focusing on Europe, so Europe has pledged to reduce emission by 55% by the end of the decade, based on levels in the 1990s, and with the aim of reaching net zero by 2050. This package of measures is called European Green Deal. Again, I'm sure everyone has heard of it, but I highlighted the 3 points. I highlighted a few points here, but I highlighted in particular 3 points which will have impact, I believe, in carbon market. The first one mentioned already is the inclusion of the maritime sector in the scope starting next year already, and the development of a separate ETS for buildings and road transport, the phasing out of reallocation for the aviation sector, and probably the most important and the biggest work to date is the introduction of a new mechanism called Carbon Border Adjustment Mechanism, CBAM, that will aim to price imported goods based on their emissions starting in 2026. And I'd like to take just a bit more time on providing a bit more insight on that. So CBAM is essentially a mechanism that is designed to combat carbon leakage. And by carbon leakage is creating a level playing field between industries that are operating in the EU and industries that are operating in jurisdiction where emission-related legislation and regulation are weaker, but that are being imported within the EU. So making a level playing field here by imposing the purchase of certificates corresponding to the delta in terms of emission there at the import of goods. So this is a mechanism that is still in negotiation, but is meant to be starting in 2023 already for an initial period of familiarization. So for the first 3 years, it will be reporting only at this point, and gradually free allowances will be withdrawn on an annual basis until we reach 2032, where the scheme will be fully enforced. So given CBAM is a mirror mechanism to the EU ETS, the sector covered are not surprising. So you will find the same sectors that the ETS is already covering. There are discussions on additional sector as well, including hydrogen, organic chemicals, and plastics, but it is yet being discussed. Few words on internal carbon pricing now, and a few insights. So internal carbon pricing by nature is, well, at this point in time, is not something that is being highly disclosed, because that's an internal measure. So some companies are very vocal about it, but some are not so much. But luckily we have an initiative called CDP, the Climate Disclosure Project, that runs a regular survey across entire sectors. This is at this point in time on voluntary basis, but with this process we can start already collecting data, insights, and lesson learned. And some of the feedback we're getting are positive. For instance, there's a 80% increase in number of companies that are using or planning to use an ICP in the 5 years between 2015 and 2020. We are seeing, though, that there is still a majority of respondents that are applying a shadow price, so the theoretical version, so to say, of the ICP, while a lower portion of respondents are already taking it a step further and implementing like internal transaction. In terms of like the price point, the height, so to say, of the internal carbon price set by companies, we are mostly falling under the carbon price corridor I mentioned earlier. So that's the case for like 70% of the companies that have been surveyed and have answered the survey rather. We have 18% of the answer of the respondents that are falling within the right carbon price corridor, and fewer than 100 companies that are applying a higher internal carbon price. So at the bottom of the slide, you see kind of a breakdown by sectors that shows the median price, and only the apparel sector is showing a price point that is within the appropriate range. This is to be taken with a grain of salt, because again, that's just like a very small portion of like all companies, and some of the sectors have less data point than others, but that's therefore just illustrative. Carbon crediting mechanism. So this is quite complex, and I think, or I hope, this slide will make a bit more sense, because there are like very different versions of carbon crediting mechanism, both in terms of like scale, mandate, and way to operate, as well as different source of demands. And I think that lately the lines are also blurring, where you are seeing like compliance grade type of markets accepting voluntary grade type of credit, and vice versa. But roughly speaking, we have three types of crediting mechanisms. So international, so think about the UNFCCC, like Clean Development Mechanism, or Article 6 of the Paris Agreement. You have regional, national, and subnational. Think about California Compliance Offset Program, RGGI in the US, and then independent. So that's everything that kind of relates to the VCM. So Vera VCS, Gold Standard, ACR, CR, and there are a lot of standard, independent standards there. And when it comes to the segments, you have four main one, international compliance markets. So that's for countries NDC target, but also for sector, compliance sector demand, CORSIA, which is the carbon offset reduction scheme for international aviation, is also a source of demand, or will become rather a future source of demand for such credit. Domestic compliance markets, so carbon taxes and ETS that I mentioned earlier, some of them are using credit as part of their, or like credits from this type of crediting mechanism as part of their eligible units, at least a share of them. Result-based finance, and then last but not least, the voluntary carbon market, which I will spend a tiny bit more time to talk about. So the VCM in number in 2021, massive year, almost $2 billion in traded value, which is almost 300% year-on-year growth compared to 2020, which was already itself quite a growth from 2019. So it's not that COVID made 2021 look bad. So not only a large increase in terms of volume transacted, but also, and that's a good sign as well, an increase of the price that are being fetched. And that's a bit a result of the market squeeze we are seeing for a few years, and that is becoming more and more acute today. So, roughly speaking, I think we can say that like up until 2017, apart from like very specific segment of the VCM, the market was very much a buyer's market, and that has turned into a seller's market with the emergence of all the net zero carbon neutrality pledges. So there are segments now in the market that are really high in demand, very little supply, and therefore higher prices, and the need to rethink how to participate in that market. I think that's what I'm trying to convey with this slide, essentially saying that in the market, in the VCM market today, either you take, if you are serious, and that's the case for corporates that are committing to long-term climate pledges. If you are serious and you want to avoid to find yourself in a situation where you're struggling for supply, where you're struggling to have a good oversight on your costs, then you need to take a proactive stance, because there are an increasingly growing share of companies that are committing to some form of net zero targets. So net zero are not all equal, but luckily we are moving toward a bit of a consensus on that. But for a majority of them, there will be, a requirement for some supply of credits, if anything, for the neutralization of residual emission. There are some serious bottlenecks, especially on the removal side of the market. I will talk about these two different sides in a minute, but that's definitely something to keep in mind. The trends in this first half of the year in 2022, we are seeing a bit of a slowdown in terms of the issuance level compared to 2021. That can be explained by various reasons. Probably the context at the moment is a bit tricky. There are a lot of players that had entered into the market in 2021 that are now taking more of they are more like looking to see what's going to happen, and also there is still some level of uncertainty when it comes to regulation from host country where all of these projects are being implemented. Something that doesn't change at this point in time. The market is still, in terms at least of issuance, the market is still very much dominated by two types of credit: avoidance, nature-based solution, and renewable energy activities. So that's almost 80% of the market for these first 6 months, and a very limited supply of removal. So only 13 million tons issued for these first 6 months. So to give you an example, I worked a few years ago for an airline, and we did some GHG accounting for their emission, and their emission was ranging, it was 2019, so pre-COVID, but their emission was ranging between 8 and 10 million tons a year. So to give you a perspective, that one airline, if they were to neutralize this emission, they would essentially sweep out the entire removal market. I'd like to finish the session on a few concepts that I think are worth talking about, and that I find I come across again and again. And the first one, this one is for me like the greatest misconception today. Carbon neutrality and net zero are two different things, and it might be obvious to you, but there are still, in my experience, a majority of people that kind of use the terms somehow for what they believe is the same things, while that's clearly not the case. So just take a second for understanding what's commonly understood as carbon neutrality, at least by companies. Essentially, companies are emitting emission, right? But this emission will normally tend to decrease over time due to improvement in efficiency, development of new innovative processes, new fuels, whatever. So that will tend to decrease over time, but we don't put stringent decarbonization requirements. And on a yearly basis, the company does their GHG accounting and purchase and retire an equivalent amount of carbon credit offsets, and there is just no regulation on the type of offset that are being used. There is no regulation on the vintage of the offset being used, etc., etc. So that's what a lot of companies, a lot of corporates still kind of believe in. And for me, I'd like to warn them that this kind of paradigm is coming to an end very soon, I believe. So therefore, what is net zero? What does it mean, and what's the difference between both? Well, in a net zero situation, the company first and foremost goal will be to decarbonize drastically and reduce their emission, and their pathway need to be grounded in science and aligned with 1.5C scenario if possible. So the company will work really hard in decarbonization until they reach a target year that they will have set themselves, at which point they only are allowed to emit so-called residual emission. So this level of residual emission will be different depending on the kind of sector you're operating in. And in order to validate this net zero, the company needs to neutralize this residual emission with carbon removal credits, so to counterbalance and sequester an equivalent amount of CO2 that they are still emitting. Companies are also encouraged, but this is optional at this point in time, to take further climate action by using or implementing beyond value chain mitigation measures, and that's like the lighter green part in that visual here. Just a slide on avoidance and removal, and again, apologies if you're very familiar with that, but I see so much confusion that I thought was worth mentioning. There are three types of credits. There is the avoidance and the removal. The avoidance is, think about a solar plant, like a renewable energy plant, whereby you implement renewable energy plants in a country that is traditionally powered by fossil fuel plants, and you are producing an equivalent amount of electricity with no emission. You are therefore like decreasing the emission factor of the grid, and under certain circumstances, the developer can actually claim credits for that. So that's like the brighter the pink part of the visual. On the other hand, removal are projects that are designed to capture and sequester permanently CO2. They come in two types: nature-based solutions, and as the name implies, nature-based, and tech-based. So think about, when it comes to nature-based, like reforestation, afforestation, but also blue carbon. So mangrove, for instance, like reforestation of mangrove is one that is being talked about quite a lot. And when it comes to tech-based, direct air capture is probably like the easiest example. So both of these type of credits are eligible for different aspects of a net zero pathway. So removal, as I mentioned, is mandatory, and that's for neutralization of residual emission, while avoidance can be used for beyond value chain mitigation. By the way, removal can also be used for that, and perhaps it's a good idea to start, lining up a supply of removal credit in the process reaching net zero, to make sure that a company has the right amount of removal available. But at this point in time, they are scarcer. They are more expensive. So it's expected that the majority of beyond value chain mitigation will be tackled through avoidance at this point in time. The good news is that there is quite a landscape of frameworks and guidance that have been issued. So they are either like ongoing or have recently been issued and are in public consultation. The first one is obviously the corporate net zero standard that essentially set the scene. So the SBTi, the Science Based Target Initiative, has become a bit of the consensus on that matter, and their corporate net zero standard set the scene for what should be done in terms of like decarbonization and reaching a net zero. The SBTi is also working on a series of target setting guidance specific to each sector. It's a work in progress for some of them, and the first guidance documents have been issued for a few sectors, including the financial sector. So this was released, I believe, last month, and if you haven't had the chance to have a look, definitely suggest to read it. It's quite substantial. It's 180 pages, if I'm not wrong, but definitely worth it. And then there are two other draft guidance that are worth mentioning. They both are tackling market integrity. One from the demand side, the VCMI guidance that regulates or aims to regulate corporate claims. So what can be a legitimate claim for a corporate player, and guidance on the use of offset, in particular for this beyond value chain mitigation part. And the ICVCM look at the supply side and carbon credit quality and environmental integrity. So just a quick recap. These are the three entry points in the voluntary carbon market if you are a company, a financial institution, or whatever. First and foremost, decarbonize and secure a pipeline, a supply of removal credit for neutralization of your residual emission from the moment you reach target year, but also consider consider compensation of unabated emission in the transition periods, and there is the possibility to have legitimate carbon neutrality claim under certain circumstances, which include, for instance, being fully on track and disclosing on a yearly basis progress made in the decarbonization pathway. So you can not only decarbonize, but also compensate for what's going on still in the process and claim carbon neutrality before reaching a net zero state. And last, which is something that a few companies are already considering or implementing, which is compensation for historical emission. And Microsoft is a good example of that. Essentially, Microsoft was launched in 1975, and they've done some GHG accounting of the impact done over the years, and they want to take action on that. Last, I'd like to finish on a bit of a uplifting note and a bit of a hopeful note, and maybe something that will be speaking to you. I strongly believe that while the VCM can be seen, voluntary carbon market and all of this regulation can be seen as a necessity, but it can also be seen as an opportunity, especially for financial players. And that's just an example of a structure that could work, because we are in a situation where you can have two types of factors on, let's say, the investment and structuring front. The financer that is ready to mobilize capital and is in the market for return, and on the other hand you have the corporates that have committed to a long-term target and therefore require a secure supply. And there is a bit of a matchmaking that could be considered, and in fact that is being considered already. I worked on a few transactions of that nature, because the company can have their own requirements and their own needs for the future, but they're also often part of a broader ecosystem of partners, suppliers, subsidiaries that will all have their own requirements, so they could also become a bit of a supplier to their network, their ecosystem. And in case there is surplus that is being generated by the investment vehicle, let's say a carbon fund of some sort, there is always the possibility to go to the brokering route. Here I mentioned brokering partner, but if you're a financing partner with a trading desk, you could probably play that role as well. And there is, as I mentioned earlier, a growing volume of companies that are committing and therefore will require one way or another supply of credit going forward. I think that's it. Thank you.
Thank you very much, Leo. Are there any questions from the audience here in Vienna? René.
I have a direct question to Leo, if possible. What do you think about investors investing in CO2 certificates with an underlying on CO2 futures, which is based on available EU certificates? Is that positive? Is it negative? Does it have an impact? What is your take on this?
Yeah, and maybe I didn't understand. So financiers investing in CO2 certificates that will have an underlying in the EU ETS?
Yes. So basically I create a structured product which keeps the price of the CO2 or the carbon price of the European carbon price.
To be very honest with you, my area of expertise is more on the VCM. So all the structure I've contributed to are VCM based, so not so much for compliance markets. So I'm not sure I'm the right person to answer that. But if you want, we can take it offline and just drop me a line, and I can put you in touch with colleagues that may be in a better position to address that question. Because all the, as I said, the transaction I worked on, they were for voluntary target and they're net zero, not so much generating future compliance grade credits.
Thank you.
Sorry.
Thank you very much, Leo. Are there any further questions here from the audience? Are there any questions from the online? Yeah, there were one question, but we answered this morning already, but just for clarification's sake, don't you worry. All the presentations which are available will be sent by the end of next week, also with the link of the overall recordings of today. Yeah, so the whole day was recorded and will be recorded, and you will get all a link next week. And this link contains then the direct connection to the recorded data and also to the responsible and respective presentation involved. Yeah, so that everybody can have a look at it at their spare time for their own convenience. Leo, you see that's a lot of respect and a lot of requests in this very tedious topic, and very important for all of us going forward on the ESG side. So therefore, thank you very much for shed a light on this very problematic topic, which is very much detailed and where you gave us a real insight. So thank you very much for your effort.
No worries. Thank you very much. And I saw a few questions, and I invite, because I guess we don't have time to take the question, but I invite everyone to reach out. You have my name, so you can find me on LinkedIn or whatever. And I'm happy to take some of these questions further. I saw one about whether or not companies should claim carbon neutrality, and I think that needs a few minutes to answer, and we might not have the time, but feel free to reach out.
Great. There was one last-minute question coming in and was saying, Leo, would you say companies should not claim that they are climate neutral?
Yeah, that's one of the great questions, I think, and that's what I was trying to tackle when I try to make the distinction between carbon neutrality and net zero. The short answer to that is that they should definitely claim carbon neutrality, but only, and really only if, and that's the big if they are engaged and can substantiate that they are engaged in a net zero pathway, meaning that the first point of consideration for a company today is to decarbonize, disclose, and use every possible effort to decarbonize and reduce their emissions, scope 1, 2, and 3, to an amount that is appropriate and aligned with the SBTi guidance. On top of that, if they want to claim carbon neutrality, they can do so if they are aligned, and under certain circumstances that the VCMI, so the Voluntary Carbon Market Integrity Initiative, as proposed, then the carbon neutrality claim is legitimate and can be taken seriously. If, however, a company go for a carbon neutrality claim without substantiating that they are making every possible effort, not only making every possible effort, but that they are disclosing and providing evidence that they are in line to meet their target, the target that they've set for themselves, then if they don't do that, they are, in my view, in a very high risk, reputational risk, to being accused of greenwashing and just paying for offsets to continue business as usual. And that's a massive, massive reputational risk and liability for companies. I worked in the past for a few companies that were considering this kind of initiatives, and I helped them reconsider, because at the end of the day, all of this cost, all of these efforts will be for nothing if they are being fully criticized on the press, on the media, and there is no credibility in just doing direct offsetting without taking the steps to decarbonize.
Okay, great. And there was a final question on the slide 28 concerning the VCM landscape. And the question was, and the supply bottlenecks you mentioned, where do you see possible solution to overcome this bottleneck or these problems you mentioned?
Bottleneck, that was mostly, that relates to the removal side of the market and some sectors of the avoidance side. The issue at this point in time is that we were in a market that was suppressed for many, many years. There was virtually no money for replanting trees. There was just no commercial incentive to do so for a long period of time. Therefore, for a long period of time, there were no projects. All of a sudden, from like 2017, 2018, 2019 onward, you start to have lots of pledges and therefore a lot of demand. But the reality is that when it comes to the removal side, we are talking about nature-based solution because the tech-based ones are not ready yet or not at scale. We are talking simply about trees that are growing, and you are planting a sapling. It will take 10, 15 years before it actually reach the scale and the maturity. So what is required to overcome some of this bottleneck? Further investment, further work in identifying location, further work also in R&D on the tech side, because there are there is hope on that side as well. There are some innovative technologies that are starting to show hopes. Thinking about like a few. They used to be startups, but now they are raising hundreds of millions. Climeworks is a good example of the likes. There was also a shortage of widely approved methodology internationally that will make the issuance of credits credible and possible. But there was one recently released for biochar, which is another area that at this point in time has not been touched so much, but that could show great potential as well, both in terms of the scalability, the price points, as well as all the social development and associated benefits.
Great. Leo, thank you very much again for your insight on this very complex material. And thank you very much for your effort, and see you soon.
Thank you very much. Enjoy the rest of your conference.
Have a nice weekend.
Bye. Bye. Cheers.
So, ladies and gentlemen, now we come to the next slot, and it's about how CFO's job have changed with ESG. And on the agenda, you see Walter Oblin, CFO of the Austrian Post. Unfortunately, for personal reason, we had to make a quick change there, and we are really glad that Harald Hagenauer, the investor relation head of Deutsche Post, can really of the Austrian Post, sorry, yeah, that was my mistake, of the Austrian Post was really willing and being very flexible in order to come here. And for Harald, as an introduction, Harald is not just the head of investor relation of the Austrian Post, and this includes not just the normal investor relation job, but also corporate governance, corporate sustainability, compliance, auditing, and last but not least, risk management. And Harald also oversaw the IPO of the Austrian Post, and besides his capacity as head of investor relation there, he's also the CEO of Csrd, which is the Circle Investor Relation of Austria. So I think, Harald, without any further ado, we are glad to have you here. Please come on the stage.
Thanks, Frank. Thanks, ladies and gentlemen, for the introduction, first of all, and thanks for being here on this conference and talking about this very important topic of ESG. And yeah, let me directly start on the question: how did the life of CFOs have been changed the last couple of years? And first of all, best regards from Walter Oblin. He got sick yesterday, and so I had to step in and could step in. But yes, it's right. It has dramatically changed. That's what I wanted to say. And just look on all these topics which are on the agenda right now. These topics haven't been there three to 5 years ago. So we are really, and we have just opened the door into a new world, I have to say. And the whole financial team, the whole financial accounting team, and the CFO, the world of the CFO has changed dramatically. To understand what we as a company and how we as a company can participate in this way, in this path to CO2 neutral or CO2 free societies, I maybe give a short introduction in that what Austrian Post is and does. Of course, I think you all know postal companies is quite a simple business. We are dealing with, and that's the same all over the world, we are dealing with mail, mail on the one hand side, is a shrinking business. There are no love letters anymore. On the other hand, parcels. Parcels is a growing business. We all know all our Amazon and other sendings have to be delivered every day, every door, and that's why we have a growth in the shrinking part of our business. And number three, that's a case for Austrian Post. We still have a number three division, which has some kind of retail activities and banking activities. And when we talk about sustainability, of course, for the whole management team, it's so important, first of all, before we talk about reportings and these run for ratings, we have to talk about the definition of goals, first of all. Number two, to set actions, so a measurement plan, what the company can do, what is really possible, what is not possible, and how this way in the next 10 to 20 years has to be done. And then number three, to measure it and to report it. So for us as a company, of course, we have set out a strategy already a couple of years ago where we've said in the middle of it, whatever we do, in which kind of markets we want to be in, it's all about going this way in a sustainable way. So let's start with the targets first. We said we're not just talking about the E and the S and so on. We have to take a look at the whole company, the whole concept of the group. So first of all, of course, as an economic target, we want to grow. We are a 2.5 billion company right now. We want to grow to a 3 billion company in a couple of years. But we have set clear targets for all our environmental and all our social standards. And I think the main topic, of course, here is these carbon neutral activities. And that's why we have made a clear investigation what we can do, what are our measurements here on our way to Paris. And we've set out a master plan, a so-called sustainability master plan of Austrian Post 2030. In total, we have focused about 14 topics, what we can do and what we have to do the next couple of years. And these topics are a standard program, a process program within Austrian Post. So you see here a couple of topics focused on the whole group, on the development of the whole governance of the group. It's all about our products, how we define products, what can we do on the customer side, what can we do on the procurement side, and on the governance and compliance itself. So that is the G in some of the ESG activities, but even more because we really have to work on the product activities and that how we have been seen on the client side and on the business customer side. Number two, I think that's for the most of us very clear. It's all about green and efficient mobility. It's all about buildings. When you think on Austrian Post or on typical postal companies, it's clear we have to deliver millions of mail, millions of parcels day by day. Yeah, there are for Austrian Post during the Christmas season. On some days we have to deliver 1.5 billion of parcels in Austria a day. And that's, of course, a dramatic amount of machinery, logistics, and people have to work for you to deliver all the parcels you order today to be delivered tomorrow. And I think that's our challenge, and that's why it's clear it's all about how to treat the equipment and how to treat the stuff. So that's our program. So we have to define action steps in all of these 14 activities. And we've just heard about this way to Paris. Also, we as Austrian Post have agreed on the science-based targets. So yes, we want to keep the global warming down to just plus 1.5%. And in order to do so in our industry, it's necessary to have their own equipment, their own direct emissions under control or reduce them by 38%. But we feel also responsible for our suppliers, sub-suppliers, all the trucks and drivers available for Austrian Post on the street, not just in Austria, but within the group. And that's our ambition for the next 10 years. That's a tough ambition, I would say, because we are not just available in Austria, but also in a lot of countries in Eastern Europe and in Turkey, where it is not that easy to get a lot of a green vehicle fleet, which is subsidized by a big amount. That's not there in those countries. And that's the challenge in reality in our case. For our Austrian operation, we started the program in 2010. So 2010 was the first year when we said, let's define what we can do as a postal company. At that time, we got a mailing from Hennes and Morris from Sweden. They said, what's the footprint on our parcels in Austria? At that time in 2010, we didn't even know what a footprint is. Yeah? So we had to calculate the footprint. We had to divide it by all the trucks and drivers we had. We had to define a footprint per parcel. And so we designed a program which was called then CO2 neutral, because we said we want to reduce what we can and compensate the rest of it. And for a postal company, for all postal companies, there are typically 3 types of emissions responsible for a footprint. Number 1, buildings. Building was a third of Austrian Post, and there we could do a lot already the last 10 years. So the electricity, new photovoltaic plants and so on. So that's where we had a lot of success the first 10 years, I would say. Number 2, it's the cars. In Austria, we have about 9,000 cars to deliver all the parcels and mail. And we think, and that's our plan, that we are ready by 2030 to bring the footprint of all the cars, all the vehicles to 0. And then number 3, it's all about the trucks. And that's the most important in size, but also the challenging part of the story, because at the moment, as you know, there are no trucks available which are really CO2 neutral. So but that will hopefully happen soon, and that will then the program maybe starting 2025 or maybe 2030, when the trucks are available, either driven by fuel cell or whatever, or battery-driven cars. We just see prototypes on the street right now, but we think in a couple of years' time they could be really ready for a bigger fleet. So this is a chart on all the cars we use. This system works. I think 10 years ago we all had the story that there are so many cars available and they can drive 100 miles a day. That was not true. That was never true. Now it is true. It works, and we can say we can definitely say we think there's no risk that we cannot fulfill our strategy here to be 100% CO2 neutral on the last mile. So these kind of vans and trucks which are necessary for the postal industry, they are available. Of course, our challenge is that we always need bigger trucks. In the chart we show you right away, to reduce the footprint is not that easy, because at the same time of the last 10 years we had an increase of the parcel transport volume by 70%. So the more parcel you order, the bigger the trucks, the bigger the transport kilograms we have to deliver day by day, and that's why that is the challenge that we also cope with the capacity there. So trucks, I think, is possible. We also work very much on photovoltaic plants. When we change our whole vehicle fleet to electrical fleet, we will need double the electricity of right now, and our idea is to get 30% of all the electricity by our own production. So in all our sorting centers, we are now installing big photovoltaic plants, and that's just the idea then for the next year, or for this year, by the way, and for the next 10 years, we think we can triple this amount of installed capacity on our plants. So that's the action we have to do, and the goals we have set. And now we come to the reporting activities. And here you, of course, know that there are hundreds of reporting standards available. The last 10 years, we all did report. All the companies did report on the basis of the Global Reporting Initiative. But it's more and more complex to find those kind of reporting standards. Which scope the necessity of the future. We think that it's plenty of work to do here. We as a companies, we think it would be very, very necessary to have a standard which is understood and accepted worldwide, not just on some kind of local base, because it's more and more complex and it needs more and more bureaucracy to really cope with TCFD, with GRR, with CDP. This fragmentation of standards is a big challenge for companies. And even more the whole taxonomy story. I'll come to that later. Ranking and rating on the capital market is the name of the game. That's clear. We as listed company and all of the listed companies have to provide information, have to fill all this information in a couple of databases. That's a mega business in the meantime. From a side story, being in a kind of rating activity, it's a mainstream story, and I think the whole capital market has learned how to deal with that, and it's very, very necessary. So also we as Austrian Post and a lot of other companies are aware that reporting as a basis for good rating and ranking is so important. And when we come to the buzzword taxonomy, I have to say also here, a new world is on the table. I think I have to say to all the analysts and investors, there's a kind of religion on the table which is not ready yet. I think we have to be very clear there. We know all the ideas, we support all these ideas, but the regulations sometimes is creating very, very confusing reporting activities. In the first year, of course, all the company had to report the taxonomy eligibility. That did work quite well, I would say, even besides the fact that most of the standards haven't been really clear. Now this year we have to report the compliance to the standards, and we still are in big talks with our peers in the industry, because the simple question is an electric car taxonomy compliant, yes or no, says a clear, it depends. In our case, an electronic car in Spain is compliant because they are using summer tires. We in Austria or Germany are using, in winters, winter tires or some intermediates. And these intermediates, they are about 2 to 3% less efficient, and that's why they are not compliant to the taxonomy. And that creates a crazy story. Of course, if we change our vehicle fleet to about 10,000 electronic-driven cars, is this an activity which is supported by the taxonomy, yes or no? Still, on the paper, would create a no at the moment. So, as you see here, we are in talks with some institutions there, and we think the religion is not really written in stone at the moment. And that's why a lot of troubles and a lot of discussions in the whole CFU community is going on the details of this wonderful idea. And one part is also very important, definitely for the whole financial community in the companies. That's reporting itself. You just can report what you measure. You have to remeasure group-wide information, and our controllers of the companies, they have to learn, and also the auditors have to learn, that it is much more complex to report on kilowatt hours or liters instead of euros. Euros are created as euros and cents. Everyone can measure that. A kilowatt hour on electricity, on heat, is not that easy to calculate on buildings and to plan on buildings and to measure on buildings. So a 2% up or down is also okay. That's what we had to learn, what our auditors had to learn. So by the end of the day, I think we as the companies and also the CFOs had to change the focus on the internal auditing team, the internal finance team, to come up with good measurement activities, come up with good reporting, come up with good ratings and ranking stories. And by the end of the day, we as a company, of course, still want to support the capital market with a story which is consistent and says, yes, there is a growth. We want to be a growth company. We want to be a reliable company and deliver what we always delivered by the end of the day. That's dividend. But we also want to go in the direction of a decarbonization of our logistics. We think we can do that. The good thing in our case is that we don't have to change big processes like the steel, the gas, the paper industry. Yeah? We just have to handle buildings and cars and trucks. Yeah? And we think that's possible. So I think whatever happens the next 10 to 20 years, I think we will be ready. If the trucks are available in 10 years to 15 years, then we can say this is a clear chance and a clear target to be really CO2 neutral in 20 years' time. We think we can get it. So by the end of the day, we think ESG on the agenda of a CFO of a company is so important. We see a very good response coming from the capital market, very good response coming from the labor market, but also from our customers. They love that we started this program of CO2 neutral already 10 years ago. They see that there's progress going on. They see our green cars on the street, not the taxonomy, but the clients see that. And that's why we think it makes a lot of sense to go on this way and to focus on ESG and the further activities there. Of course, it would be very, very helpful to find standards where we, as we always say, 80% now is better than 100% never. I think you know this saying, and we very often see an idea of regulators that they want to regulate everything into the last mile, but I think that's not important. Let's create a non-financial reporting system where 80% is regulated and the rest can be done by the market. At the moment, we spend sometimes more money on the regulation side, on the auditor side, on the bureaucracy, and it would be easier for us to buy 5 more cars than pay 5 more consultants. So it has a high complexity, but I think it's worth it, and we want to go this way, and we think and hope that you as an institution can help to come down with the whole regulation idea and to bring it in a way where we all can focus on the same way by helping the environment, by helping to stop the global warming. Thanks a lot.
Harald, thank you very much. Are there any questions here from the audience to Harald? Jean-Philippe.
Yeah, as you are part of the investor relations team, do you notice more questions from your investors, whatever bond holders or shareholders in the last years? And if yes, what are the key questions that you notice? And do you have in your general presentation, I mean, ESG dedicated slides, or do you do specific ESG roadshow? How do you organize all that?
Very good question, because a lot of people always say we report tons of material, thousands of key figures, but no one is asking that. Yeah? And that's partly true, yes, because when we go on a roadshow, we most of the time meet active investors, and they get from the back office the alignment to talk to us. So in reality, there's a filter behind it. Yeah? So we cannot see, and sometimes we cannot see the filter. A lot of the money in the meantime is passive invested. So it's so necessary as a precondition to get to all these talks, to get to the meetings, to be ranked in a kind of A or B category, where each fund, each big institution has this kind of filter before we come into the chance for a meeting. So yes, it's necessary as a precondition, first of all. And number two, in the meantime, we distinguish classical roadshows where you meet those kind of investors focusing on the story, on the earnings season and the quarterly figures. And we're doing some roadshows just for these back office guys, I have to say, where we want to clarify and answer their questions on the ESG matter. That's a different type of roadshow where not the quarterly activities is so important, but the system of the company, the targets, the long-term targets, and the measurements you've been in place. Yeah?
There's another question.
Thank you. As the question was how for CFO the ESG changed the whole system, my question would relate to the kind of ESG KPIs within the variable remuneration policy of board management. And I would be interested if you already have implemented some ESG KPIs, quantitative and qualitative, for your board members and especially for the CFO.
Mm-hmm. That's a very good question. That's when we are on a roadshow, on an ESG roadshow, and we talk to all these ESG guys, that's definitely one of the top 3 questions we get there. So how are all the ESG activities linked to your bonus? Yeah? And in our case, yes, of course, that's in the meantime, I think, I wouldn't say standard, but it should be standard, and it's expected to be there. And in our case, yes. Of course, the bonus of the board, in our case, and also on the second level management is linked to ESG. In our case, it's about 20–30% of the bonus can switch with the ESG targets. Yeah? So our board has a clear number of cars, number of social standards, and so on. I think 50% of their so-called, we have a kind of modifier, yeah? And 50% of those soft fact activities are just linked to ESG. And I think in total it makes 20–30% of the bonus up or down, and the compensation up or down with ESG activities.
Any additional questions from the audience here in the room, or perhaps from the online audience? No, thank you very much.
Thank you.
Thank you very much.
Thank you.
Thanks for your willingness to jump in, and please give our regards to Walter.
I'll do so. All of us.
Thank you very much. So now we're coming to the last but definitely not least point, and I already outlined this morning in the lineup. The last session of today will be about a very controversial issue, and we wouldn't have talked about that issue last year. I already mentioned this morning. It's about the conventional weapon topic in a changing global geostrategic and political environment. It's a very complex topic, and it's very actual, unfortunately. And fortunately, I could persuade a colleague of us and a member of the ESG Commission, Jan Westring, who we are very familiar with for more than a decade, because he always participated not just in EFFAS conferences, but also for more than a decade in the EFFAS summer school. And therefore, we are very well familiar with him and his Swedish colleagues. And while we were elaborating on this topic, we were coming to this setup, and there are 2 people who are joining. It's Jan and Jan, so to speak. And we start with Jan Westling, and he is Senior Portfolio Manager. He works for the Swedish Pension Agency, so he's well familiar with a huge AP program we all know from 1 to 7. And also, he's very well familiar with EFFAS and our work, because he's an active member of the ESG Commission. And without any further ado, Jan, welcome. We are glad to have you, and perhaps you start, and then I introduce Jan P. and his presentation in the second go. Please go ahead.
Thank you very much. Thank you very much, Frank. As you said, this is a very, very difficult and broad topic with several moral issues. And I would like to start to talk about the consideration and the different thoughts you can have as an asset manager if you invest in the defense industry, or if you not invest. See, you can take the next here. Yeah, I'll try to. Oh, sorry. Here, why do we have this discussion right now in Sweden and Finland, and why don't we have that before? As you know, the Russian attacked the Ukraine on February 24th and shocking the world. But despite the shock, the Western countries managed to act together against Russia. And as a consequence of this, Sweden and Finland have applied for membership in NATO. So, you know maybe that all the 30 NATO states must ratify the application, and so far 23 NATO countries have ratified the application. So what about the war from the Russian perspective? If you as a Russian sits in the Kremlin and put your glasses on and see what's happened in the former sphere of interest, you will see the major expansion of NATO since 1990 until today. The former Allied states has been your, so to say, enemies. So that's one question. And interesting is that Russia had a major military exercise with Belarus in September last year called Zapad, which means West in the Russian language. 200,000 soldiers participate. So after that, Russia came with the proposal to NATO and said so here, that NATO would not further expand its presence eastwards. And NATO must remove all troops in the countries that become members after 1997, which are 12 of the current NATO members today. And also the third one, NATO would not hold exercises in Ukraine. That was quite funny, I think. Then came the war, as you know, the 24th of March. The Western countries united sent weapons to Ukraine, and Sweden, for instance, it was actually after 3 days was prepared to send weapons to Ukraine. And Sweden have never sent weapons since the Second World War, and then we sent the weapons to Finland. And the Swedish states here broke the stance that we for decades had in Sweden, that Sweden may not export weapons to warring countries. Here on the picture we see the First Lady Olena Zelensky, who speaks in the US Congress and asks for weapons. And I think that she's very, very skilled describing why a country needs weapons. She's asking for weapons, not just for war, but to protect one's home and the right to wake up alive in that home. So, what about the investment strategy with or without the defense industry? What will be the effect if we include or exclude defense industry in our asset management? Yes, here we can see a graph. The blue one is the FTSE Euro First aerospace and defense sectors, comparing that to FTSE Euro 300. And as you see, it's a significant overperformance if you have this year invested in the defense sector. And also if you see what's happened in the States, this is S&P 500 aerospace and defense sector, and there is a big difference in performance if you have put your money in the defense sector. When you want to screen weapons for investments, then you need to decide which type of controversial weapons you want to exclude. And this is the points that we do in the Nordic, and especially in the Swedish country. As you know, there's a variety of ESG consultants over there which do screenings, and this is a company called Csrd that we use. And this is also the controversial sectors that we screen and don't invest in. And we have actually a threshold of 5% of those companies as well that we don't put in our portfolio. And if you, as we are a global investor, we invest in have global equities. If you exclude weapons of any type, this is what's happened. 3% of the index is disappearing, corresponding to 80 companies. But if you exclude just nuclear weapons, it's 20 companies, and controversial weapons, just 8 companies. But the thing is that normally the most of the companies that are doing conventional weapons are also doing controversial weapons. So you need to do an exclusive analyst, walk through the company, see exactly what they are doing, and Is it controversial? And what kind of weapon producer are there? More and more, as mentioned, like as we know, include companies which can achieve to the 17 global goals, FN global goals. But the UN themselves claims that by excluding companies which consist the production and distribution of weapons, you can achieve the 70 global goals. But is it actually true today? As we have learned the last half year, the most important task for a state or a country is actually to protect freedom, peace, and security. So that's very hard question to ask. If you believe or agree in this, you can invest at least in one of these UN SDGs. Maybe you can invest in this number 16. This is a picture and an example also from the Swedish weapon producer Saab. Saab is known for the fighter jets and anti-tank weapons. And they claim that if you can invest in Saab, you can also achieve 8 of the 17 global goals. But here's a moral question as well. Sweden sent weapons to Ukraine, but Saab is actually not allowed to take orders direct from Ukraine, because the Swedish legislation is very restrictive. But this time, the politicians have changed their attitude, and they can change it back again. So it's hard to say exactly what they're meaning. And talk about treaty and conventions. This is a quite funny picture. When Sweden signed the Ottawa Treaty on the prohibition of anti-personnel mines, we didn't scrap the mines we had. We just changed the name from troop mine to defense mine. So that's a way of doing this as well by the country, different countries, or the defense from the different countries as well. So what about the Swedish asset managers? Have they changed their investment goals or policies due to the war and due to the application to NATO? The answer is, if you start with the government-owned asset managers in Sweden, so you know the AP funds, we have 7 of them. So they just before the war and after the war, and right now, they can say that we can invest in companies that comply with the international convention that Sweden has signed. And for my stake, my company, the Swedish Pension Agency, we still don't invest in weapons. And weapons, it means both conventional weapons and controversial weapons. But with the war, discussion has started in Sweden and the rest of Europe. Is weapons necessary evil in order to be able to defend democracy, freedom, and independence of the countries? So I hear, but haven't seen, but more and more asset managers that previously excluded the defense industry have changes the mindset and start to include some of the weapon producer. I have here a quote from one of the AP funds that is just covering what I'm saying right now. Ukraine war has raised many questions for investors. Yes, we know that. And one example is, are the defense industry can it be responsible and sustainable? And they said that it's possible to make responsible and sustainable investments in the defense industry, but you need to choose the different companies you are investing in. That's the main most important thing. and here also, what about the Swedish banks? The Swedish banks here, Esg Banken, changed the policy regarding the Swedish weapon producer Csrd. The thing is that we in Sweden only have one quoted defense stock, and that's Csrd. And the Swedbank has also changed its policy regarding that sort of companies. But the rest of the companies, the rest of the banks, the Svenska Handelsbanken, Nordea, and Danske Bank, has not changed its policy. But Danske Bank actually accepts weapons for that they are necessary for achieving peacekeeping missions, for instance. So everyone is just slipping on this question, but it's going to be very interesting next year to see if and how and what the different investors has done, and are they changing the investment policy? That's my big question for the coming year. Yeah, I'll stop here.
And thank you very much for this presentation, and gives us an overview about how the Nordic countries do think about this very controversial topic, and especially also from the Swedish point of view. We will come back with questions in the Q&A part of it, and I would like to change now to Jan P, because he will give us a more detailed view on the sector as a whole. Jan is the Secretary General for Aerospace and Defense Industries Association of Europe, ASD. And as we are all obviously not that familiar with, I'll just give you some additional information. And the Association of Europe is the voice of a sector representing more than 3,000 companies of all sizes from 18 European countries. The combined turnover of these 3,000 companies exceed 230 billion euros, and the number of direct employees exceed 870,000 people. Yeah, this gives you an idea, and ASD actively supports the competitive development of the industries in Europe by advocating common positions and providing technical expertise to international standards used worldwide by industry, customers, governments, and international organizations such as the NATO. Yeah, and I think having said that, it becomes pretty clear that this is a very important organization where we obviously are not that familiar with, Jan, so therefore we are really glad to have you here, and I would like you to hand over and give us your presentation, because from what I saw at first glance, that's at least as important and impressive to what Jan already outlined from the asset manager point of view. Please, Jan, go ahead.
So thank you very much. I hope that you can hear and see me. I would have put a high pleasure in being with you in Vienna today, but unfortunately it didn't work out, and I am joining you from a hotel room in Portugal as we speak. Having said that, thank you for the introduction, and I will just start sharing my presentation and see hopefully that could work so that you get it on the screen. So here we go. I was already introduced. I have one key message to all of you today, and I think I will start with that because all of the rest of the presentation is really supposed to lead that key message into evidence. So my key message here today is that if access to finance for the defense industry is being made more difficult for different reasons, such as taxonomy, ESG criteria, etc., it would be counterproductive to the policy statements of all EU member states and all EU institutions. So what I'm saying is basically the leaders, the political leaders of the EU and all of its member states do not wish to see a challenge with access to finance for the defense industry for a number of reasons. And now this is obviously something that one could debate. What does that mean and how can you avoid having challenges with access to finance? But I'll come back to a couple of these issues in the presentation. But first of all, before putting that into evidence, that statement, it's a bold statement, before putting it into evidence, I will give you some background in order to better understand why the policymakers are making these kind of statements these days. So this is the content of the presentation, shortly about ESG. Most things has been said, but I will also touch upon a global outlook for the industry as a whole, for Europe as a whole, because it matters. We need to think about the European defense industry as a part of Europe and Europe as a part of the global scene. So what does the overall outlook look like? I'll touch briefly upon that, and then I'll touch upon what has happened with the ESG criteria's taxonomy, eco-label, etc., and the policy shifts that are now coming. So let's get on to it. And it was already mentioned, the geographical scope of ESG, so I won't touch further upon that, but this presentation is obviously something that you can have and distribute afterwards, so maybe it's nice that the slide is in there anyway. And by the way, here you can see our direct company members at the bottom of the slide, and you can see the different national associations on the two sides of this slide. The numbers were also touched upon, and maybe just to say that here we can split also the numbers to see how many of the employees are directly involved in the civil aeronautics business and how many in the defense business. But what is important to know is, of course, these numbers of direct jobs relate only to the people being directly employed in the companies represented by ESG. So the actual number of jobs created around this industry is by far bigger than what is on this slide. So this is where I think it starts. My message to you would start, hopefully, to get a little bit more interesting. Oops. What you can see here is at the pace of which the economic shift from the West to the rest, to use a little bit of a worn out expression, is actually happening. You can see on this slide the darker colors, you have Europe and you have the US, and here you can see that in the 1980s to 1990s, Europe and US accounted for 75% of the global GDP. You can also see that in a forecast towards 2041 to 2050, roughly around the mid-century here, we would be accounting together with Europe and US for less than 50%, somewhere around 45%. And all of this is at the expense of the growth in especially Asian countries, Asia Pacific. So this is a dramatic change of power when it comes to GDP, and all the financial houses are pointing at the same thing. Whether you speak about the Economist, as we speak here, Economist intelligence unit behind these numbers, or PricewaterhouseCoopers or any other actor, you can find differences on details, but not on the bigger trends. And obviously all of this being as a result of the demographic shifts and trends that are being produced by the United Nations. So having said that, if we think about a statement very often put forward that the US and the European industry, generally speaking, are global leaders, this is true, but it's based on investments in the past, and it's based on a situation where there were very few other competitors. Now looking ahead, the biggest economist won't be found in Europe or US. This is also clear. And what is driving the competitiveness for the future is obviously investments in R&D, R&D&D, etc., the market, the demand side. So what that we need to take into account that Europe is about to lose 1/3 of its relative size as of today versus 2050, and how to deal with that when it comes to defense. So what does this mean, particularly this change, if you look into the defense sector? I changed my slide. I can't see that it has changed on your side. Yes, now it did. So here you see a number of different circles. I don't know in the room whether you can see the details behind it, but they are supposed to be a reflection of the size of the defense budgets by 2020 and the different countries in the world. A couple of comments on this one. The relative size of the circle is supposed to reflect the size of the budget in the respective country. The blue one obviously being the US budget, the red dot, second biggest here, being the Chinese budget, and then you have numerous other countries. Couple of interesting comments. First of all, on the staples that you can find to the right of the slide, you can see that there are only 16 countries on this slide, and still it covers more than 95% of the global defense budget. So when you speak about the global market, we need to realize, first of all, if you know 16 countries on the defense side, then you know the global market. It's not bigger than that when it comes to money. Secondly, if you consider that China, first of all, a comment maybe on how much these countries need to invest of their GDP to be at this level. The US is invested some 3.5% of their GDP to be at this level of defense investments, $738 billion in 2020. So 3.5% of their GDP is invested to be there. The Chinese are investing 1.7% of their GDP to be at the level where they are now. And this level where they are now is roughly the same level as the combined or aggregated EU investments in defense. So China today is as big as Europe at equal level. But with the difference that China only is investing 1.7 and has an extremely sharp growing trend in terms of its growth of GDP in general, which means that by 2050, if we look at these forecasts, what do they mean? By 2050, the Chinese economy is by PPP, Purchasing Parity Index. The Chinese economy is foreseen to be 50% bigger than the US economy. And should the Chinese by then also want to increase the proportion of their GDP that they invest in on the defense side from 1.7 to maybe 3.5 or 4% or something, you would easily get a red dot being as big as the blue dot or even bigger. And this outnumbers, of course, the European budgets by far. So if you put Europe in a context, this is the European defense spendings since 1960 until 2020. We speak about 6 decades with decreasing defense budgets. I touch upon that because you need to realize that it's really the investments in defense that is driving the competitiveness. This is what at the end of the day is telling you whether you would have future systems, future products that can compete on the global market with the competing capabilities or capacities. And this trend is obviously not looking that attractive. So let's put it into a global comparison. And here you see the US trend. Now, unfortunately, these slides are not accurately from the perspective that they cover different time periods. So this time period here is 1990 to 2020, so 30 years, 3 decades. And here you can see the US defense spendings constantly increasing. This is the top curve. Then you can see the bottom curve is the Chinese, and the middle one is Europe. Europe being relatively flat over this time period. The Chinese coming obviously from almost nowhere as compared to Europe, coming up to the same level roughly as we speak, 2015, 2020, we're at the same level, but the Chinese economy is forecasted to grow by far quicker than the European, and the Chinese are increasing their defense spendings, their defense budgets by far quicker than we are. So the trends here are alarming. Then, okay, so let's realize that Europe is about to become a much smaller, relatively speaking, smaller actor on the defense scene. Then, of course, it would be extremely important that we spend our money wisely. But is that the case? And this slide is showing you to what extent Europe is working together, meaning collaborative projects, procurement, development, R&D, etc. And this slide is unfortunately also a little bit old. It's 2016. Should it have been 2020, we would have had a total defense expenditure roughly around 200 billion. But the size of these collaborative would have been roughly at the same level where they are now. So basically saying The message here is that Europe is working through national supply lines when it comes to defense. There is a very little component of collaborative development. And of course, if you become a smaller and smaller player constantly due to the macroeconomical developments, and you insist on being unable to cooperate, of course, this will increase the speed of which Europe becomes less competitive. So this slide, I call it the sickness of the system, the illness of the European collaboration. And now I'm coming to what are the policymakers doing about that? This is the European Defence Fund. I don't know how familiar you are with this fund, but this is an 8 billion euros fund that was launched 2021. It had a couple of precursors. There was a preparatory action for defense-related research. There was a defense development investment fund, etc., as precursors to learn how to do this. But the European Defence Fund is a game changer. It's a milestone from the perspective that the European Commission is moving from being only a regulator to also be a customer. So the Commission is investing EU money into collaborative projects that spans over all of the different phases, from research and development until market uptake. And it's not the Commission paying everything. The Commission is seeing this as an incentivizer, as a catalyst. So you can have 20% of the overall cost can come from the Commission, and the rest would have to come from the collaborating member states. However, my message to you is that there is a lot, in order to put in place a European Defence Fund, where you take collective European money to incentivize collaboration on the defense side, there is an enormous push. This would never have happened without the support of all European member states and the Commission, and realizing how severe the global situation for the European defense industry really is. So this is the first evidence that policymakers are indeed investing in the defense sector and the European defense industry, and wanting to make sure that it can survive and stay competitive for tomorrow. And what has happened then is, obviously, we touched upon already by previous speakers. We've had the war, but already before the war, what we saw were two initiatives driven by the European Commission, and we've seen a number of national initiatives as well. We've seen the initiative of the taxonomy file, and we've seen the eco-label file. Now, both of these initiatives at the European level are currently stopped. None of them are moving as we speak. And the reason why they're not moving is obviously that there were early indicators that defense should be seen as something that should be excluded due to ESG criteria. Different levels of defense engagement in the eco-label fund. I think they spoke about more than 5% of defense of the turnover of a company coming from defense, and then the company would have to be excluded in a fund. And taxonomy was sort of trying to pack defense together, or group defense together with child labor, with alcohol, with pornography and things like that, saying this is not a sustainable activity. And as these files were being prepared in the European Commission at a lower level, obviously the financial market actors took that as a reason to really reconsider, should we be stuck with this kind of when this taxonomy is coming, when this eco-label is coming, should we be stuck with this kind of companies in our investment portfolios or customer relationships, etc. And we have seen the financial market actors during 2 years turning the defense industry its back. So this takes different shapes. We have banks saying no to loans, saying no to guarantees, even ending long-lasting customer relationships with the defense companies simply because they are in the defense sector. And we've seen institutional investors trying to get rid of their part of defense companies in their different investment portfolios. And we've seen the same on the retail side. So we've seen everybody more or less trying to decrease their interface towards the defense sector, which is in total contradiction with the defense fund, because this is now then, if you want to ensure that you have a competitive defense industry, an effective way to counter that would obviously be to make sure that this sector does not have access to finance. So what has happened then is that we've made this very clear. We brought this up to the attention of prime minister level in different member states, of president level in different European institutions, notifying them that what is the effect of these initiatives that are ongoing at the EU level? Is this really aligned with what you are trying to achieve at the top level? Because we seem to think that this is very counterproductive. And as an effect of that, there has been a number of statements coming from the European Commission. And we have been informed, this is why I dare to say it to you as well, that the taxonomy will not move forward, the eco-label will not move forward in any way that would be detrimental for the access to finance for the defense industry. This was already, I mean, my key message here is on bullet point number 1, already before the war in Ukraine, the top level of politicians in member states and EU institutions invested heavily in the defense sector because they know what lies around the corner for the coming decades. This is why we have the European Defence Fund, why we have PESCO, why we have the Military Mobility Fund, etc. What has happened with the Ukraine war is that this has become a further catalyst to put defense really as a political priority. It has led to a shift in perception. This is true, as has been said. It has also led to an increasing demand of production of defense equipment because we need to replenish all the stocks for those countries that has delivered equipment to Ukraine, and we need to be prepared for a long time war, which means that we need also to be able to ramp up production to refill those stocks and to also deliver what is needed when the different member states are now realizing that their defense budgets has been too low and they want to increase them. So when it comes then to these policy instruments, on the 15th of February, the European Commission came out with an official public communication highlighting, as it's stated here, initiatives on sustainable finance remain consistent with the European Union's efforts to facilitate the European defense industry's sufficient access to finance and investment. So here they are saying for the first time, we need to make sure that we are not countering ourselves with these transversal activities that are going on in the European Commission. And this has then continued on the 11th of March, where we had the heads of states meeting in Versailles. This also led to a statement that is similar to the one that I just read. But this one points out even also by making best use of the possibilities of the European Investment Bank. So now the Commission is also looking into can we make better use of the European Investment Bank? And as you know, they have an exclusion for defense in their lending portfolio, which is heavily questioned now whether this makes sense or not. And on the 21st of March, the EU Strategic Compass, which is really the document that outlines everything in terms of strategy for European defense. This is a quote from that compass. Important to ensure that horizontal EU policies, such as initiatives on sustainable finance, remain consistent with the European Union's efforts to facilitate the European defense industry's sufficient access to public and private finance and investments. So when I told you at the beginning, my key message is that the politicians want to, at the top level, member states, institutions, ensure that there is no taxonomy, there is no eco-labeling that would go against the interest of access to finance for the defense industry. These are the evidence slides for that. And this is the reason why the taxonomy and the eco-label files has been stopped at the Commission as we speak. My last slide, I would, of course, want to say that from our perspective, and this is what we stress a lot as well, we think that the ESG criteria has been taken a bad turn from the beginning, or a bad starting point. We believe, as Jan said here already, we believe that, first of all, as a precondition for anything that has to do with sustainability, you need free and open democracies, you need open societies, you need access to free trade, you need a number of things. You need authorities, agencies that are free from corruption, that are free from being hostile, overtaken, etc. For all of that, the defense industry is part of the solution. You need border control, you need maritime surveillance, you need cybersecurity. All of that, the defense industry is part of the solution. So we would like to turn it around and say the defense industry is de facto a key enabler for any kind of sustainability. without having the proper ground in a society, you can't develop anything in a sustainable way. On top of it, given what the situation looks like, of course, it's a profitable investment as well, so it should be attractive from that perspective. So I guess I would stop here. I hope that there would be questions maybe, and I'm happy to take any of them. I am, as said, being Secretary General, I'm not a specialist on ESG, but I can take any sort of overarching and strategic questions around this. So thank you very much for listening.
Jan, thank you very much. Very impressive, actually. And I was just wondering whether there are questions here from the audience or the online audience.
First of all, thank you very much for very clear presentations and ESG criteria impact on the investment targets in defense industries. I would like to make a comment to the first presentation made by first speaker. First of all, thank you very much for quoting the wife of our president, Mrs. Olena Zelenska. But before this, you showed the slide with the date of 21st of March. I don't know if it's misprint, because the Russian aggression against Ukraine started on 21st of February. Or you would like to tell with this date something else? Thank you very much.
No, actually it's misprint from the beginning. That's correct.
Any further questions, opinions, statements? Then perhaps from our side, a question perhaps to Jan. How do you see the reaction within the other NATO or EU members concerning conventional weapons going forward? Perhaps it's a question to both of you, but I think also especially from the portfolio management point of view, because when I do share views here with our colleagues from Austria, Switzerland, France, and what have you, we are still relatively reluctant, obviously because we don't have any direct frontier, and so your situation is totally different. Therefore, you made this incredible move from being a neutral country for more than 50 years then to joining the NATO. So therefore, I was just wondering, when you have the background also of the AP programs, how this was being received.
As I told you in the beginning, that I believed when I started to do this presentation that many have done shift in the investment policies, but they are, I don't know if you could call it confused. They don't still have decide which leg they're going to stand on. If they're going to use or change their investment policies, or keep it like this. But I think there's going to be a big, continue to big debate. And also when I called around my colleagues in the different other asset management firms here in the Nordic countries, they said that, okay, we're thinking about it, we discuss it every day, but we haven't made any decision yet. But probably it will come the coming month or half a year or so on. And we'll see what will happen, and also what will happen when we start to invest in the defense industry that we haven't done before.
Thanks, Jan. Then perhaps a question to Jan P. As your organization entails activities within 18 countries, do you expect an upcoming discussion about this whole conventional weapon matter in the public opinion of the different NATO countries going forward, and then also perhaps a change in underlying opinion?
So thanks for the question. I do indeed expect that that there will be a discussion both internal within industry, within NATO, as well as a public discussion. My feeling, generally speaking, the discussion has started on many fronts, on many levels. My feeling, generally speaking, between European industry, US industry, NATO, European and US investors, I think can be summarized by saying that, first of all, it seems that on the NATO side and on the US side, there is no contradiction whatsoever. European defense industry. On the contrary, NATO would only be as strong as the NATO members allows it to be, and Europe playing many EU member states playing an important part, being NATO members, can only contribute with what they have in terms of capabilities. So it's only from the NATO perspective, it's only foreseen to be a good move if the willingness to invest in the European defense industry is coming back again. On the investor side, I can see that this move that we've had in Europe with financial actors turning their backs towards the defense industry, it is a European phenomenon. It doesn't happen in the US. It doesn't happen anywhere else. And I spoke to my colleague, Mr. Eric Fanning, who is the president of AIA, the counterpart in US organizing the US defense industry. And just to ask him whether the US industry had experienced anything like we do in Europe right now, and he said, no, absolutely not. However, he was very pleased that I informed him about what is happening in Europe, because his feeling was that this is very much NGO driven, what is happening, and NGOs very often operate from the perspective that they try to get a major achievement in one region in the world, and when they've done that, they move to the next one. So he took it as an alarm signal, but he also confirmed that he would be pretty sure that US investors would be happy to fill the gap in terms of access to finance on the European side if the European investors wouldn't come back to the defense industry.
Great, thank you very much. And please perhaps allow me for a last question to Jan Westring from a portfolio management point of view. Do you expect institutional international investors to be proactive concerning that topic, or do you think they are going to wait for good till the opinion or action and activity of their respective administration would have changed?
I think the question is yes on the both questions, but it's so interesting when I started to discuss during the different conference this topic, because we are not, as I told you, we are not investing in weapon or the defense industry right now. But the pros and cons, when I discuss it, I have so many mails coming in from other asset manager firms that would like to have a discussion, because everyone is actually having the discussion. What should we do with this? Should we claim it as a sustainable investment or not? Because they haven't done it historically, especially in Sweden, because the Swedish church actually 2005 or even previously that said that no, the defense industry is not sustainable. That's why we are so negative for defense industry especially in Sweden, but also the other Nordic countries. But there coming more and more discussions, and I think it's going to take probably some bigger asset manager, if they start to change their mind officially, then I believe that the smaller firms also going to add also the weapon industry or the defense industry into the portfolios or the different funds they managed.
Thank you, Jan. We have one question from the audience here in Vienna.
Thank you. From a lawyer's point of view, it was very interesting for me in the last minutes that we were all, or you were all only talking about defense weapons. But from my question would be, in the defense weapons, are there also controversial weapons? Because maybe this could be the point if the transparency. For me, it's not quite clear what kind of weapons, because, for example, we as Erste Group, we excluded corporates which are producing controversial weapons. But for me, it was not clear here if the defense industry also have that kind of weapons.
So thank you for the question. If I may pop in and try to answer it. Indeed, first of all, when it comes to weapons, there is no clear internationally signed treaty that everybody has agreed upon on which weapons that are controversial and which ones that are conventional. So there are a number of treaties, and all of these different treaties are ratified by different member states, but there is no one single treaty identifying exactly that everybody has agreed upon. However, having said that, it's easy to single out a number of controversial weapons, and to exclude defense industries dealing with controversial weapons would be absolutely fine for the European defense industry. We are not a supporter of controversial weapons. However, what is often popping up in the discussion as well is defensive weapons. Would it be easier to invest in defensive weapons? And this is a much more tricky question, because a weapon is really not defensive or offensive. This is the same weapon. It's just a matter of how it is being used and for what purposes. And use the tanks like the Ukrainians are doing to defend themselves, or you can use the tanks as the Russians are doing to invade another country. So there is nothing like defensive or offensive weapons that would have a clear and decisive line. But controversial weapons, European industry very much supported that this could be excluded. Absolutely.
Great. Thank you very much, Jan. Yeah, I want to thank you, both of you, because I think that was a very interesting topic, and I think we have discussed about this for the first time on EFFAS level on ESG, but I'm really sure that this wasn't the last time. Therefore, I'm glad that we could win both of you for this very interesting presentation, and also for the upcoming discussion, which is really worthwhile. And as we have seen during the last 3 or 4 questions, a lot of things which has been really clear, or seem to be really clear in the past, are now at least up for discussions. And I think from a European point of view, we should pretty much do this in order to make up our mind how to go forward with that. So thank you very much for both of you, and to both of you. And let's talk about this in future, and let's continue. And thank you very much for your effort, and have a great weekend.
Thank you very much.
Thank you. Thank you very much.
So now I would like to hand over to my dear colleague, Jean-Philippe Desmartins, to give a wrap-up of today's 7 sessions. Jean-Philippe.
So we had a dense conference, so it is time to conclude, and in a few minutes I'm going to try to summarize all the things. The first thing I would like to say is thank you to our Austrian colleagues for the top quality of the organization and for the success of this event. As you know, more than 370 people registered online mainly. And also, so thank you. Forza Austria, will say our Italian colleagues. And also thank you for the Austrian National Bank for hosting us. So we had a first important discussion regarding the regulation with Patrick de Cambourg. Sorry, I need my glasses. So what we have to keep from this big messages is that, of course, EU regulation is important to reduce fragmentation and to improve the poor quality of data that we still have, and also increase access to quantity. There will be a big difference, we have to keep that in mind, between Europe and other initiatives. That's the concept of double materiality, and I think that's something that we will continue the discussion in the next months and years. What is sure, as long-term investors, whatever quantitative or qualitative or fundamentals, etc., we need the 2 legs today, the financial leg and the sustainable legs. Everything will be better starting in 2024, so it's tomorrow, so I have to be ready, and we all know that. and all that will be audited with the different 13 standards that we will have. Of course, regarding the convergence, there will be technical aspect, but not surprising, also political one. We had positive messages from Patrick de Cambourg and EFRAG. They have in mind they don't want hyperinflation of data, especially when they are irrelevant, and they don't want double reporting. So I think it's important to have that on board. And a lot of people today also precise the point that digitalization will help all this development. Then you had the second roundtable, dealing with the latest trends, a lot of dense things. So I just captured some messages. Sorry, I'm not going to be exhaustive. But keep in mind that ESG, it's not only the story of listed corporate, but whole corporates. And there are really huge developments, whatever sovereign debt, fixed income, and so on. There are also a lot of debates, and that's European context, but also global one, regarding utilities, electricity, in the context of the war in Ukraine. But all that explains also that we can at the same time manage the energy transition, because energy transition is simply to progressively decarbonize our European and global economy, and we can manage at the same time. What we have to say also, I keep in mind that that's the advantage of this event, a lot of different input from a lot of European countries. That's the advantage and the plus of this conference. Of course, Austria, but Switzerland, Germany, Spain, Italy, France, and I will not forget Andorra. Thank you for the colleague from CESG. There still are some disappointments regarding the evolution of the taxonomy, and personally, but also a lot of people said that they hope that we will have some progress in order to avoid too much complexity. Biodiversity is clearly one of the new frontiers that we will have to to address progressively, with modesty, because difficulty with data and methodology, but clearly part of the climate change and all environmental challenges. Good news also that in Europe we see more and more comfortable investors with fiduciary duty and sustainability, but unfortunately that's not the case, still the case in the US, and we see that really with the news flow, you know, with some pension funds attacking ESG so-called investors. For the standards, we all convene that we need standards, but please, again, we say that we can have simple standards and also convictions. And if we can avoid and stop the present confusions, I mean, we practitioners will be very happy. Importance of education, and I will come back to that with the CESG program. And we had also discussion regarding ESG and performance attribution, capital allocation, etc., etc. As you can notice, a lot of interesting things. The roundtable on human capital, we had different input, investor, academic, corporate, and clearly we need more data. We need the capacity to analyze at the same time complexity, quantitative, qualitative, but we do progress. And Professor Stefano Zambon reminded us, we as investors, our responsibility to dialogue with corporates to explain why we need so much also social data, not only environmental and governance one. For the CESG program, of course, it's a huge success, as it has been said, with high development in Europe, Spain, Germany, France, Switzerland, Andorra, but also outside Europe, for instance, Hong Kong and Singapore. And we will have a new update version starting in March 2023, and we are happy that it can be very helpful for all kinds of people, whatever they work in corporates, financial markets and other businesses. What's going on in carbon markets? That was another session this afternoon. We all conclude that carbon price is absolutely necessary, and not only because we are investors, but I mean for all stakeholders. There's today a large diversity of instruments, such as internal carbon pricing, ETS, etc. A lot of initiatives in Europe, China, Canada. But at the same time, especially in Europe, we have to think about to avoid the relocation of industrial production outside of Europe, steel, for instance, because of potential pressure from that. Regarding the internal carbon pricing, a survey from KPMG, the guy gave the figure, interesting, 80% of the companies said that they are using or plan to implement internal carbon pricing. That's the good news. The bad news is that when you look at the figures, 68% put a price under $50 US. Personally, I think it's not enough, and only 32% more than $50 US. But these markets are all developing. Just for voluntary carbon markets, $2 billion US of transactions in 2021. That's nice. But keep in mind that before compensating, the rule number one is to try to reduce as much as possible in absolute terms. There was a question, important one. Can a company claim that it is climate neutral? And the answer from the speaker was yes, but only if the company really is in action. I mean, is implementing a net zero pathway. We are for the next roundtable, interesting contribution on the subject how CFO's jobs have changed with ESG from Austrian past. And yes, the person in charge of investor relations said that it had dramatically changed in the last 3 to 4 years to report more, to have goals, actions, measures. But he emphasizes the more and more complexity of reporting with the different things, especially taxonomy. But he answers more and more questions, and they develop specific ESG roadshows and so on. And one key performance and questions more and more asked to CFOs is, are there some ESG criteria part of your objectives for your remuneration? And that's true, that's a common and increasing question that we all question. And I conclude with the present debate on weapons that we just had there. Of course, it's a complex, difficult, broad, and completely actual topic. There is no simple answer. Nothing is black or white, as you know. And it was very interesting to have the evolution and the perspectives that asset owners and asset managers have in Nordic countries because of their culture, history, and geographical location. And it was interesting that some investors are changing their policy, for instance, to invest in local weapons producers. Of course, we debated the importance to differentiate between conventional and controversial weapons, even if sometimes it's difficult to differentiate. The big message was important to keep access to financing for European defense industry, even if it is still a big challenge. And I noticed that also one of the important challenge for Europe is to collaborate more in the future for all these investments. Now, I would like to conclude with this last session with an old call from the Roman Empire 2,000 years ago, where it was said that if you want peace, be prepared for war. I think that's something we have to keep in mind. But with a much more positive message as a general conclusion, I wish you all a very peaceful weekend. Thank you. Have a good evening.